this may be the first quarter that we start to see a noticeable hit to profit margins.
Margin is at risk of further compression, and earnings expectation for this year is perhaps too rosy.
What we have here is the consumers reposition very quickly.
Lower income households are going to have a harder time, and we are going to see some pulling back.
What these companies are doing is acknowledging that there is weakness ahead.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Just one more downgrade to global growth from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures down 1/3% on the S&P. TK, the OECD joining the World Bank to try and look ahead to the next year or two.
Every 1/10% makes a difference, John. John, it's like Dow 10,000 is how I'd put it. Global growth of 3% is Dow 10,000. 2.9% feels way different from 3%. WTO and World Bank, sub 3%. OECD comes in at a solid 3.
That's how you lose me, Tom, and lose me early on in the show. But I'll move past it because we're friends.
First
Dolly
30
Yen,
seconds.
It didn't take him long, did it? It didn't take him long, Bramo. Let's get it back on the rails, on the tracks. TK, 133 pushing 134. Dolly Yen.
The calculus of June is worth noting. Things are not unraveling, John. I don't want to be inflammatory, but the market, when you look at the Bloomberg, is absolutely fascinating. As Vincent Reinhardt with us yesterday would say, level doesn't matter. It's the rate of change, the first derivative, and the rate of change of the rate of change, the second derivative, and they are in play now. German 10-year. In Japan, we could spend the whole show on Japan. It's so important.
Well, let's start there. Let's question that word. Market. Lisa, the Japanese government bond market, the 10-year, did not trade once in yesterday's session. Literally not once. Today, yields higher in the US, higher in Germany. What are they doing in Japan? Nothing at all, because the BOJ is sitting there capping yields. They're increasingly isolated. We've talked about that shock absorber. It's in the FX market, and everybody else is pushing against it.
So Tom just has to mention the Dow. You have to mention the JGB market being a market, and that's going to tweak me because, frankly, it is not a market. There is nothing markety about this. It is completely controlled by the Bank of Japan. At least they're trying to. And as you said, the pressure reliever really is coming from the currency pairs that we're seeing have a dramatic ramification here. At what point does Japan care? Japan's still trying to frame this as a good thing, that their exports are going to be more plentiful, are going to be more available to the world, that possibly they could get tourism. Really? Are we really buying that this could actually give a support to their economy? Or is this being viewed as a massive headwind? And that is the tension they're going to have to address heading into year end.
What will they tolerate? Governor Kuroda has got a two-handle on inflation in Japan at a national level. What are we looking at in Europe, in the US? 8 handles and maybe 7, 6 through the rest of this year?
Yeah, and frankly, we're talking about Europe. The GDP estimates came out this morning higher than people had previously expected for this year. And this actually gives the ECB more leeway to raise rates, people are speculating, because growth is hanging in there a bit more than people had previously expected in the face of inflation. All of this pointing to rate hikes in all of the developed markets, the likes we have not seen for decades, and Japan moving in the opposite direction.
I have to admit, growth estimates from the World Bank, the OECD, the IMF, they don't get me excited, Tom. Usually they are about 3, 4, 5, 6 months late. Yeah. We'll say this, though, about Europe when it comes to the OECD. They're looking at 1.6% growth next year. They're looking at 4.6% inflation. That is not the scenario, the base case of this ECB as they meet this Thursday.
John, two quick observations. One is the 2023 guesstimates. In many cases, there's a guess, and then there's a lower guess for the year following. I need to go back to Japan, John. I think it's so important. And the massive distinction of Japan is this is not your father's Japanese analysis. We've got Morgan Stanley coming up here. They have the giant Robbie Feldman in Tokyo, and he would point out that this is a Japan that is now a heavy importer of goods and raw materials. That was not the case when they were moving Toyotas out the door.
Let's get to it, Tom. Futures down about 0.4% on the S&P 500. On the Nasdaq 100, we're lower by about 1/3%. Yields climbing by 2 or 3 basis points on a 10-year, getting comfortable in and around 3% over the last couple of days. And looking at crude, Lisa, 121, and look out, $5 a gallon. the average gas price in the United States, we're getting closer and closer to that 5 handle.
And how much is that going to be the key election issue as we head into the midterms? Today, President Biden is heading to Los Angeles for the 9th Summit of the Americas. The key issue here is that Cuba, Venezuela, and Nicaragua, all were not invited, creating some issues with Mexico's leadership. Interesting to see how people can talk about nearshoring a lot of manufacturing at a time when there is this concern about supply chain disruptions. Today, as Kaylee was talking about earlier, Bloomberg's Tech Summit is taking place in San Francisco. Interesting to see what we can hear from the CEOs of Uber, Expedia, as well as MasterCard, looking to how we can gauge the slowdown in the consumer appetite, as well as some of the shifts in technology right now. And today, Russian Foreign Minister Sergei Lavrov is heading over to Turkey to talk about unblocking the Black Sea for grain shipments out of Ukraine. How much is this real talks, right? I mean, we've heard real skepticism from Kyiv about how much could actually get achieved here. But this is key in terms of the world's food supply, John, so a lot of people are watching this.
Abramo, thank you. I want to turn now to Brian Weinstein, the head of global fixed income over at Morgan Stanley Investment Management. Brian, you said this: the Fed may keep hiking in clips of 50 basis points until something breaks. Can we talk about that something breaking and maybe have a little look at what's happening in Japan over the last few months?
Sure. Yeah, you mentioned it earlier. Well, first of all, I mean, the Fed has to keep hiking 50 basis points until there's some semblance of a demand slowdown, because that's all they've got, right? They can't help the supply side. And so the Fed is on a mission here. And then you said before about markets. I mean, we've seen a couple of these markets really teeter. Japan not trading is probably an extreme example, but you saw the high yield market gap 50 or 100 basis points higher and then 50 basis points tighter. There is just a lot of uncertainty out there. It's been a long time since the Fed couldn't bail us out. And it's going to keep going until there's an accident somewhere.
Brian, James Gorman doesn't want you to talk about second derivative dynamics out there, but let's go first derivative right now. Where is the rate of change right now that interests you most?
You know, I think we're getting back to looking at interest rates again. I think the credit market's adjusted. 10-year notes, I think, have an uneasy truce at this 3% round number. But I think it's pretty clear that we're not going to rally a lot. In other words, we're not going to wake up with a 2.25 10-year notes. It's not the direction of travel. So I think the question is, are we going to have this market move to an uncomfortable level, or a level where investors will choose income over capital appreciation, where they'll buy fixed income over equities? We had a few moments of it at 320, and I think we're going to test higher levels again.
We're going to test higher levels again. Why? Which investors are stepping back? Which investors are not coming back to Treasury yields for income?
Well, I think there's two things. One is that the Fed, I think, played this game a bit with the pause. I think that was maybe just to calm markets temporarily. I don't think we can predict a pause given what we're seeing in labor markets, given what we're seeing in relatively strong growth, and given what we're seeing in inflation. So I guess the first thing, Lisa, is that we just don't see investors flocking to fixed income, and there's still a lot more coming, and obviously QT is part of that. So I think that's the first thing. The second part, I think, is really just unease with inflation and growth. I don't think are going to see the turnaround as quickly as people want to in order to flock to safety. So I just don't think a 3% 10-year note with 8% inflation is enough to change the dynamic of this market.
Brian, you talk about an accident. Can we talk about the anatomy of a market accident, what it looks like in this new world? Is it credit-based, given the fact that you've got the likes of Deutsche Bank saying that they are going to see some sort of increase in defaults in the next couple of years, or is it somewhere else?
You know, listen, I think in credit, we understand that the default rate will go up, right? I think it's somewhere, as maybe John was hinting at, that it's liquidity based, right? That people expect infinite liquidity at a price. But what you're seeing is less stuff trading, right? Again, Japan trading 0 10-year notes is a bit of an anomaly. But in the gappy moves we've seen in credit, for example, I don't think you've had a significant amount trading. So I think all it needs to be is we wake up one day and the JGB is not at 25, it's at 35, and that could unhinge the rate market, which could cause liquidity, people just to pull back and then things to have gappy price action. So I don't think we're talking about some esoteric crisis. It just could simply be that price discovery moves very, very quickly and surprises people on the wrong side.
I know a lot of people in fixed income who are dying for the return of price discovery in certain markets. Nudge, nudge, hint, hint, the JGB market for one. Brian, thank you. Brian Weinstein there at Morgan Stanley Investment Management. Thank you, sir. Lisa, looking for pockets of leverage. Where's the leverage? I hear that a lot. Where's the leverage? Household balance sheets are pretty strong. Corporate balance sheets, we're told repeatedly, are pretty strong. The fundamentals are decent. Can we talk about a firm? A firm,
yes,
and some of these loans that they've made. not going as well as some people might have hoped for. They have got 12.7 million customers. They extended around $3.9 billion of loans in the first 3 months of 2022. The stock is down over 80% this year. The team here at Bloomberg pointing out that some of these loan packages, the value of them is going in the wrong direction.
So this is the classic buy now, pay later, and people aren't paying later after they've bought. And that seems to be the warning coming from the securitizations, right? These loans to consumers that have been packaged and then sold as bonds to investors. People who are analyzing the credit quality of those securitizations are seeing a deterioration, which is leading to some concerns about the consumer balance sheet. When do they start pushing back? When do basically the base costs of everything that they're buying start to impact how much they're willing to spend?
That's one to watch. I'm going to catch up with Julie Beale a little bit later this morning, who is also on board with this story, that this could become a problem for some of these names in a much bigger way. Here's a problem for Credit Suisse, Tom. The 6th profit warning in 7 quarters.
You're going to go there, are you?
We've got to go there. The 6th profit warning in 7 quarters. The team here at Bloomberg reporting, Tom, job cuts could be coming. Tom, what a change in the last 12 months
John,
to have all these banks loading up on talent, fighting for talent, and now reports of more job cuts to come at a company that's really struggling to provide a guide for the path forward.
John, paragraph 42 of my agreement with Bloomberg says I only talk about Credit Suisse at Brasserie Lipp in Zurich. I mean, over, a $42 omelet.
And a strong drink.
Yeah, that would be true. They need a strong drink. This has been a train wreck for 30 years. I don't want to go into it. Other than Mr. Gottstein has a lot of courage to make tough decisions. John, this is a key phrase. Culturally, they don't want to make them. This is about culture and nationhood, not finance.
When does the patience, Lisa, of David Harrow and others run out with this name?
Yeah, that was my first question. My next question is I want to read Tom's contract about when he'll talk about certain things, what he has to be eating,
right.
and where he has to be while he's discussing.
Forget the food. This is not about the blue M&Ms. This is all about a drink. It always is.
I liked how Brian at Morgan Stanley, he mentioned 3 as a round handle. I mean, that's like Dow 10,000.
You're going to keep bringing that up?
Yeah.
Okay.
You
do
got
you want to quote it now?
No, I want to look seriously.
I'm pleased you're serious.
John, as Lisa mentioned, the credit card report from the Fed yesterday was stunning.
Let's pick up on that in a minute. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. More problems for Credit Suisse. A Swiss lender has issued its 6th profit warning in 7 quarters. It expects a loss at the group-wide level and investment bank in the 2nd quarter. Bloomberg has learned that Credit Suisse is considering a round of job cuts, part of a renewed push to cut costs. Here in the UK, Bloomberg understands that Boris Johnson will go ahead with legislation to override parts of the Brexit deal. That risks inflaming tensions with members of his very own Conservative Party and the European Union. The Prime Minister's government has been pushing to rewrite the Northern Ireland Protocol that keeps the region in the EU single market while creating a customs border with the rest of the UK. Former German Chancellor Angela Merkel warns that isolating Russia is not possible long term. In her return to the public arena, Merkel said in an interview that Vladimir Putin made a big mistake by invading Ukraine, but she said there is a danger of Putin forming an alliance with China if he does get boxed in. In San Francisco, residents have voted to recall progressive district attorney Chesa Boudin. Boudin tried to reform the criminal justice system, but critics accused him of being too soft on crime. About 60% of those voting favored ousting him. He will be replaced by an interim district attorney chosen by the mayor of London Breed. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists. This is Bloomberg.
Bringing inflation down should be our #1 priority, and President Biden, in an op-ed on inflation in recent remarks, has indicated that it is our top priority.
Janet Yellen, the Secretary of the Treasury, in the crosshairs, under the spotlight, through all of this over the last couple of weeks in a much bigger way. From New York City this morning, good morning to you all. Tom Keene, Lisa Abramowicz and Jonathan Ferro. Futures negative 20. We're down 0.5% on the S&P. Yields higher by 3 basis points, back through 3 on a 10-year, 3.0030%. On a WTI call right now, Tom, WTI up by 1.24%, 120.88. And I'm just looking at the average gas price, Tom, just inching away, closer and closer to $5.
Well, it's jump condition Wednesday here. We've got yen moving out near 134 level, weaker yen. Brent crude 122 moments ago. John, I do want to note we finally had a breakout of a trend here on Turkish lira. I get it, John. It's idiosyncratic, but I'm sorry. You've got to watch it, particularly with the geopolitics of the Black Sea. We're going to do more data checks today, folks. I mean, there's some really interesting nuances going on. Right now, we're going to do a little bit of politics because the politics folds into the economy, because we've been told for years that the elections of America are about the economy. It's the economy, stupid. Maybe not. Emily Wilkins joins us with a brief on the first Tuesday of June, or second Tuesday of June, the elections last night. Emily, I'm going to cut to the chase. Defund the police didn't work out. What is next for the progressives and liberals of this nation who, as a generalization, were crushed last night?
Well, they have to figure out a new way and a new message of moving forward, because between the Los Angeles mayoral race and the San Francisco attorney general, the message was very clear last night. Voters are responding to the high levels of crime that we're seeing in a lot of cities, and they're rejecting some of those progressive policies put out there that are saying go tougher on police and easier on criminals. And you saw President Biden really latch on to this after Eric Adams won the New York mayoral race, saying that, he did not support defunding the police. He wanted to support the police. He wanted to have their back. And Democrats really trying to figure out measures where they can both hold the police accountable while not necessarily defunding them. Being able to say, hey, we are giving police departments more money. We are giving officers more support, but we're also setting limits on things like, say, no-knock warrants.
Bring it back to your Washington. The senators from West Virginia and Arizona, they're not progressive. They're not liberal. Where's the new definition of the middle ground for the Democratic Party, given what we see? Is the middle ground Speaker Pelosi?
I mean, I think I would even say it's probably a little bit more to the right of Speaker Pelosi. I mean, she likes to pride herself in being a progressive, but obviously as leader, she tries to stay on message as much as possible. And she's aware right now of what the mood in the country is. She's aware of that President Biden's approval ratings are quite low, that Republicans have a huge leg up in this midterms if you look at the polling that's being done right now. And there's an awareness that voters, their appetite right now is not really for more progressive candidates. At the same point, in some of these primaries, because of the voters who come out and vote, tend to be more towards the left and the right of their respective parties on the whole, you are seeing some progressive candidates go ahead and win over more moderate candidates across the country. I think, Tom, a lot of this is going to come down to what districts they run in. Even last night, we saw some Republicans who have bucked Trump on certain things slide to victory in states like New Jersey that tend to be a little more purple to blue. But in states like deep red Mississippi, we saw Republican members who took very similar votes, see very strong challengers in their primaries be forced into runoffs. And so it kind of seems to boil down to exactly where in the country you're running as far as what your policies need to be and how aligned for Republicans they need to be behind the former president.
Emily, I just hear Tom's voice in my head saying, it's the economy, stupid. It's the economy, stupid. It's $4.92 on average for a gallon of gasoline in the United States. And this is something that Talking Points cannot get around. What is the cohesive plan for Democrats to address this, as it seems like there is not a ceiling in sight?
I mean, you're absolutely right. I think for primaries, it's a unique dynamic. But when it comes to the general, it is absolutely going to be about that inflation, about those gas prices, about how much a gallon of gas is. And Democrats, they've really tried to get the focus off of inflation. I mean, you heard Secretary Janet Yellen say yesterday, kind of pointing out that inflation is also happening in other developing countries throughout the world. You've heard Democrats really talk about trying to lower prices on various things. I think you're going to be hearing more of that as we potentially see progress being made on the legislation that passed about U.S. competitiveness with China. That's the bill that has the $52 billion for semiconductors in it. It's something that lawmakers from both sides of the Capitol, from both parties, are working on negotiating right now. And it's something that leaders have identified as potentially easing some supply chains, helping get some of those prices back down. I think you're going to be seeing a lot of focus on that. But to a certain extent, a lot of what's going on with inflation, you can't control it from Washington, D.C. You can't control it from the White House. And I think to a certain extent, Democrats know that they are in trouble come November.
You can try and control the message. And when it comes to messaging, Secretary Yellen has been the focal point for a lot of people over the last few weeks. Emily, is there a question mark on Secretary Yellen's future at the moment?
We haven't really been hearing too much of that here in Washington. I think there's just a number of other things to focus on at this point. Certainly, she wasn't the only one to incorrectly call that inflation transitory. I think there is a sense that, she was able to kind of stick to the messaging, stick to the talking points yesterday when she spoke with lawmakers on Capitol Hill. At this point, I think there's more pressing issues in D.C. rather than the future and the fate of Secretary Yellen. She had a lot of goodwill going into the role, a lot of expertise, a lot of support. And I think she has maintained that even as she has admitted that she was wrong about inflation.
Emily Wilkins, thank you, of Bloomberg Government down in D.C. I promised us a minute of some Abramowicz coverage on consumer credit in America. Lisa, it is going higher, and it's going higher.
So the Fed put out a report yesterday talking about how consumer credit has risen yet again in April after a record surge in the prior month. Why? This is my question, right? How much are we seeing consumers confident about their future versus not caring? They can get credit, they can lever up, and then prices don't matter. How much is this the scenario? Which side of the coin as we talk about the strength of the consumer? And frankly, on the other side, you do see banks wanting to extend credit because they need to make those loans. So they have an incentive. They're incentivized lenders at a time when consumers need to spend. It's not a clear picture to me.
Tom, what do you make of it?
I think that things have tightened up because of the core costs across the American deciles. The lower deciles are flat out doing better. There's no question about that. But the great middle class is looking at the monthly bills in a nominal space, John. They're looking at nominal mortgage, nominal rent, nominal gas, nominal auto, all that kind of thing. And it's killing them, and they've hit the charge cards to boot.
Lower and middle income groups getting squeezed a bit more by gas prices pushing $5 a gallon. Got some Brits listening in thinking $5 a gallon, come on, it's nothing. Except it is. It's something. It's a whole lot if you budget for something and then it increases by a huge amount. Futures down by 19 points on the S&P. We're down by about 0.5% from New York City. This is Bloomberg. Live from New York City this morning. Good morning to you all on TV and radio. Here's the price action. We're negative 0.5% on the S&P. On the Nasdaq 100, down 0.4%. A whole host of cuts to the global growth outlook. Yesterday, the World Bank at 2.9%. The OECD just about holding on to a 3% for global growth over the next year or so. We'll talk about that with the OECD in just a moment. That's the equity picture. Bond market story looks like this. 2s, 10s and 30s in America. Yields lower yesterday. Big question about whether there was a disinflationary element to the target story yesterday. Maybe we can touch on that a little bit later. Yields higher again this morning, though, up by 3 basis points, back through 3% to 3.0067%. Won't spend too much time on this. I want to turn to foreign exchange and get you set up for the ECB. The ECB two-day meeting starts a little bit later. We'll hear from them tomorrow. Expected to lay the groundwork for a hike in the following meeting and maybe even the one after that, the one after that and the one after that. Euro dollar just a little bit stronger here at 107.09. That's where you get some strength in the FX market against the dollar today, because elsewhere there's some real dollar strength, particularly against the Japanese yen. Dollar yen 133.93. Staring down 134 and levels we haven't seen since the end of February 2002. That currency pair, Tom, positive 1 full percentage point as the rest of the world, much of the rest of the world, starts to think about hiking interest rates, following the Fed, doing what EM's been doing for a whole lot longer. Tom, as they do that, the BOJ is looking increasingly isolated.
I would say, John, the summation of our guess is a 135 level is a round inconvenience statistic where maybe things start unraveling for Mr. Kuroda in the Japanese financial system, maybe just picking 1 point as suspect off dollar-yen, but the rate of change here is enough to get Laurent Spoon going.
What do you think they do, Tom, in response to that? Do they let go of the cap on a 10-year JGB? What do you think they do in response to that 135?
I will defer to the late and fabulous Martin Feldstein, who was dismayed, John, at the cultural slow-motion exercise when they cleared the banking system. Why would this be any different? They got to clear out the zombies. They got to be efficient. But I'm going to say this till I'm blue in the face. This is not your father's yen story. They have a trade deficit. They're getting crushed by import dynamics.
And as Lisa has said a couple of times, Tom, I don't think we can even call some of this a market. Dollar yen right now, Tom, 133.93.
This could be a 1-hour conversation. It is so good, and she is so qualified. She's chief economist at OECD. Laurent Spoon joins us now on a trip around the world. And Laurent, I'm going to be selfish and go to the growth recession you call for in the United States, where you've got an ugly statistic, and then the next year it gets uglier for the United States. Well, take that out to a global economy, and the benchmark you and I studied in school of 3% global growth as being lousy. Is our global economy heading or in a growth recession?
Well, hi, Tom, and thanks for inviting me. The global economy is paying a very hefty price for the war that Russia is leading into Ukraine. And yes, this is pushing down growth quite a lot to 3%, as you say, which is just about one of the low rates we have seen. And it's pushing inflation even higher. We're getting close to 9% or a little more than 6% if we're excluding Turkey in the OECD economies.
Do you ascribe to the idea that the only way to break Lawrence Summers stagflation, the only way to break this, given the war and given the rest, is tight monetary policy? Is that the only way you get this done?
So I think we have a little more messages than this in there. And as far as monetary policy is concerned, we have, still healthy growth, employment, and high inflation. So what we're saying is remove some monetary policy accommodation. Monetary policy, as you very well know, cannot address supply shock, but they can signal that they will target this, by telegraphing what they're doing. And in those countries where there is obvious excess demand, then yes, monetary policy should be tighter.
Laurence, what's the main swing factor that led to the downgrade and that could potentially lead to more downgrades ahead?
So the main swing factor is really Russia's aggression into Ukraine. As you know, we were already having inflation going up because of the pandemic and the issue with China's supply chain and zero COVID policy. So that was already affecting us. Now, the disruptions and the cut to the production of cereals, of energy coming out of the war is obviously raising inflation. And this higher inflation is undermining consumer confidence and therefore consumption. One of the things we say, if you allow me just a 30-second sentence on this, is that the burden of inflation, the cost of the war, should be fairly shared between employers and employees, wages and profits, so as to avoid a wage price spiral.
So this is one of the reasons why perhaps you accuse the United Kingdom of having taxes that were too high and saying that they had to cut them in order to give people more buying power. How much does there have to be, in some ways, fiscal expansion, despite the idea that people are pointing to some of the fiscal expenditures as being the cause of inflation?
Well, there are several reasons why the UK has lower growth than other G7 economies next year. One is the higher inflation. The other is tighter and faster monetary policy tightening, and also faster fiscal consolidation. So what we're recommending to the UK is actually to consider the pace at which fiscal consolidation is taking place if growth was too slow, as fast as what we're describing.
Laurence, the OEEC is part of the alphabet soup of the OECD, are the people that actually prosecuted the Marshall Plan. How do you respond when we hear so many people in a flippant way say what we need is a new Marshall Plan on Ukraine and the rest as well, how does OECD and you actually feel we will affect a modern Marshall Plan?
So I think there are two things. One is what's happening in Ukraine, where, as we can see, everything is being destroyed, all the infrastructure, and so a large part of the infrastructure and the capacity, the productive capacity of the economy, and this will need to be rebuilt. The Marshall Plan goes hand in hand, as you very well know, Tom, money on the one side, but also reform, structural policy reform on the other hand, to ensure that the money is very well channeled. So that's one thing. The other thing I think people have in mind more immediately at the moment, and that we have in mind at least, is globally to avoid a food crisis. And for this, we're just saying a couple of things. One is ensure the transport and logistics of the cereals around the world so that it reaches Middle East and Africa, where it's most needed, where it could cause not only starvation, but also social and political unrest. And for this, we might need more foreign aid, which in a sense is also part of what we call Marshall Plans.
Laurence, you've got a whole host of policy prescriptions, and I just wanted to finish on the UK because you do offer some advice to the British government. Out of the developed economies at the moment, that's the one that seems to be really fighting with low growth and much higher prices in a much more pronounced way than, say, the United States or Europe for that matter. Can you run us through your thoughts on what you think this government should do right now?
I can try. What makes the UK different from other G7 economies? As I was saying, higher inflation, faster tightening of monetary policy, but also faster fiscal consolidation. And then the disruption to manufacturing supply chain, as we know, between China and some of the Brexit discussions. So there are two things, I think, which stand out. One is to carefully weigh what's happening with fiscal policy and make sure that not only the most vulnerable, but the working class just above the most vulnerable is actually being sheltered from the cost of war. And the rise in global oil prices is affecting everyone, as we know. And the second thing that we're saying is obviously trade has to resume faster in the UK.
Laurence Boone, thank you. Thank you very much. From the OECD, looking for 3% global GDP. Over at the World Bank, looking for 2.9 and looking for 134 right now in dollar yen, 133.99, Tom, getting very, very close to that level on my screen.
These are the rate of change we're seeing today, and it can be idiosyncratic like dollar lira. John, yen is not idiosyncratic. It folds in. I get the domestic focus, John, as you mentioned, with the fiction of their managing of yield as well. And at some point that's going to break. I don't want to presume to know which level, but I think it's much more geopolitics. Is an import nation, what it means to Australia up through the Pacific Rim, what it means for China obviously is front and center.
Elisa, they're getting squeezed.
Yeah, and this is definitely the issue. Paul Krugman put out a tweet that the media seems to be reaching peak inflation hysteria at the very moment. Early indications suggesting that inflation are not necessarily exponentially increasing. That said, it is this squeeze that really we're talking about, right? And I think that is what we're focused on. How is this going to affect what we're going to see ahead of time? This just distracted me because I saw this and I was thinking to myself, what does that mean? Peak inflation hysteria.
Do you know, my frustration with this, there are some great minds in economics, but when they become political hacks, what's the value in some of that coverage anymore? Did he forecast where inflation would be? Didn't he call it hysteria last year, essentially? Come on.
But this goes to your point about what hyperinflation is, right? And I don't think that it's fair to say anytime we're talking about inflation and the pickup, we're talking about hyperinflation, which you very well stated. That is not what we're talking about. It's not the runaway or unmoored kind of inflation. It's an inflation that squeezes particularly the lower class and that frankly changes the view for an economy that has become accustomed to a very low interest rate.
What a surprise. The front pages of the newspapers upset someone because it goes against their politics. I mean, ask anyone in America right now how they're doing in the low-income groups and ask them if it's hysteria. It's just a ridiculous statement to make. Equity futures down 0.4%. Dollar yen pushing 134, 133.99. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The OECD says the world will pay a hefty price for the war in Ukraine. The organization slashed its outlook for global growth this year from 4.5% to 3%, and it doubled its inflation forecast to nearly 9% for its 38 member countries. Now, Credit Suisse is considering a round of job cuts after warning of a second quarter loss. Bloomberg has learned the cuts would be spread across divisions, including investment banking and wealth management. It was Credit Suisse's sixth profit warning in the last 7 quarters. In LA, a billionaire developer will take on a veteran politician in the race for mayor. Rick Caruso will face Congresswoman Karen Bass in November. Caruso won 41% of the votes in yesterday's primary, while Bass won 38%. Both are Democrats, although Caruso is a former Republican who did not switch parties until January. Crispin Odey has recouped years of losses at his hedge fund. Last year, the Odey European hedge fund made 14%, boosting returns for the year to 110%. Combined with the 54% increase last year, the fund is now above the level set in 2015. That marks a full recovery and allows it to change incentive fees. Odey's bearish bets during a protracted bull market of stocks led to a 68% plunge. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
What the Fed has to worry about is the fact that the domestically generated inflation is so high, and that's coming from a tight labour market. Now, from that perspective, what they need to do is slow the economy, and they need to gently raise unemployment. But we all know what a double-edged sword that is.
David Page there of AXA Investment Managers from New York City this morning. Good morning to you. Futures down 0.4% on the S&P, on the Nasdaq 100 down by 1/3%. Yields just a little bit higher, up 4 basis points to 3.01%. Look out 135 on a German 10-year bund.
Yeah.
We'll talk about that in the next hour. In the FX market, euro dollar 107.28 and dollar yen pushing 134. Tom, I know that's got you excited through this morning.
It does. 2 housekeeping notes here. First of all, on David Page being on yesterday talking to Ferro off mic, folks, about English football. David Blanchflower of Dartmouth is scheduled to be with us today on Cardiff and Gareth.
And the labour market, Tom, and the Fed.
Oh, yeah, that as well.
That's gonna
we'll
be
do
maybe,
that as well.
Maybe up top. 134 handle right now on dollar yen. Can I squeeze this in just quickly, Tom?
Please.
Just want to get to Credit Suisse. Forgive the snark. Just allow me just a couple of minutes of it. Just a couple of minutes. Yesterday, we put out a story on the Bloomberg with an interview with a guy called David Miller. He's the global head of investment banking and capital markets over at Credit Suisse. And this was his quote. I've been using the entire 5 months, the first 5 months of this year, running around seeing clients and telling them we're back. 24 hours later, Tom, the headline from Credit Suisse, it's another cut to the profit outlook for this name.
It has been a process, I will
Third straight
say.
quarterly loss.
For those that don't keep up with this soap opera, this is not a 5-year deal. This is a 10, 15, 20-year cultural phenomenon. John, I want to go to what you and Lisa were arguing about with Professor Krugman, and this is inflation, and this folds into Terrence Haynes, founder of Pangea Policy, who gets it. What you do, folks, is you set up a moving average wrapped around the culture of whatever the series is. Here's the math, Terry Haynes. The moving average of a gallon of gas is the monthly bill people face. You bring this down to the rent, to the gallon of gas, to paying the bills on whatever the day of the month is. Brent crude, 30-day moving average, $113. It was $110 peak in April. We've breached through to a new monthly high on the cost of oil. Terry Haynes, how does that play for Republicans moving to November?
Well, politically, it's very good news for Republicans, and it's very bad news for Democrats. I think that's obvious. And off that, what you have is Secretary Yellen saying yesterday that that really Congress could do a lot, kind of passing the buck there, very similar to the way that President Biden passed the buck to Fed Chair Powell last week. So, what you've got is you've got an administration that wants everybody else to do the work, is not stepping up to provide a kind of a suite of solutions to really hit it, and and so the politics, as you ask me, is not going to move any off of that.
Okay, but you're reading my mind, Terry Haynes. My question is, where's the energy czar for the Biden administration? We're all very czar-like whenever we are in these crises. Where's the energy czar?
The energy czar, I think, is going home at Friday at 5 and coming back Monday morning at 9. Frankly, I have one simple test for whether there's a crisis in Washington, and it's if people stay the weekend to work. And I've been through a few where we worked for 40 days straight, like USA Patriot and all the rest. But when you have a situation where everybody from the president on down is essentially checking out for the weekend, what you have is Washington telling you that things are going to operate as normal and are not going to operate on a crisis level.
Terry, this is really important. Are you basically saying that Jennifer Granholm isn't taking this seriously enough, and that this administration is basically being caught staring into the headlights and not really prepared to understand the scope of what these gas prices and what this inflationary outlook really means?
I'm sure Secretary Granholm is taking this seriously. I'm sure that many in the administration understand very well what the issues are, what the economic stakes are, what the political stakes are. All I'm suggesting is that it's easy to tell whether people are concerned about a problem versus whether they're interested in solving it. And right now I see a Washington generally that is not interested in solving any of this stuff.
Washington being the Democrats and Republicans, just the Democrats. Do the Republicans have a plan?
I don't see the Republicans as having a particular plan either. But, I look at, things going back to, say, Theodore Roosevelt's bully pulpit. I don't see an ability or a desire, frankly, from anybody. And, the president's a Democrat. Democrats are nominally in charge. So, a little bit more of this falls on them, to really drive it and either try to solve problems in a bipartisan way, really reaching across the aisle, really being aggressive, energetic, all the rest. Or on the other hand, politically, frankly, the Democrats trying to put the Republicans on the back foot. I don't see either of that happen.
Terry, we've heard from several reports that the president is frustrated with the strategy in the White House, the approach, the messaging, what they've allowed him to do, what they've stopped him from doing. Terry, why haven't we heard more about changes, personnel changes?
That's interesting, isn't it? I'll tell you my own view on this, which is a little bit of observation, a little bit of understanding, and a little bit of a whole lot of experience, frankly, is very simply that what you've got is the president made his deal with the progressive wing of his party at the very beginning of this. It is now not going so well. The advisors that brought him to this juncture and that he let bring to this juncture, frankly, are people that are more interested in continuing their relationship with the progressive wing of the party than they are about getting the president to be, more centrist, reaching across the aisle. One thing I saw this week that was very interesting, and there were a lot of elections this week and whatnot, is you see the I'm on your air all the time talking about 4 factions, not 2 political parties in Washington. What you saw this weekend or seeing is kind of the strike back of the centrists, people that want common sense solutions, people that want problems to be solved, whether that are politicians that advanced in primaries yesterday.
Okay, Terry.
Or frankly, somebody like Matthew McConaughey who was in here asking for common sense gun solutions.
But Terry, who is the Democrats' new mayor Daley of Chicago? Who's going to pick up the trash?
Wow. that one of the biggest problems for the Democratic Party is that there's a very short bench, and there isn't an obvious solution to that. In Chicago 40 years ago, the ship righted pretty quickly after Jane Byrne went off the rails, and we went back to Richie Daley and the kind of more Daley-like model. That's gone off the rails again in Chicago. It's been righted to some extent in New York. It's clearly off the rails in San Francisco and Los Angeles.
Yeah.
But there aren't obvious solutions to that. But you've got a lot of centrists and a lot of insurgents trying to push back on
Terry,
all of that.
There's a lot of work to do.
So we'll see.
And so little time. I've got 5 seconds left. Terry Haynes, thank you, of Pangea Policy from New York City. This is Bloomberg.
This may be the first quarter that we start to see a noticeable hit to profit margins.
Margin is at risk of further compression, and earnings expectation for this year is perhaps too rosy.
What we have here is the consumers reposition very quickly.
Lower income households are going to have a harder time, and we are going to see some pulling back.
What these companies are doing is acknowledging that there is weakness ahead.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures down about 1/3%. TK, the week begins tomorrow.
The week begins tomorrow, and then into CPI Friday as well. And what you've got is dynamics setting it up. You've got a lot of movements, John, and the tea leaves across a Bloomberg terminal. Moments ago, yen weaker, a 134 print.
Dollar yen 134 and a BOJ, Tom, increasingly isolated. This cycle, this tightening cycle of this Fed is different to the last one. The ECB sat out the last one. It won't be sitting out this one. Can the BOJ do the same thing again?
And what I would say, John, is it's not in isolation. I don't have the work in front of me, but the convexity of German 10-year, I'm absolutely fascinated how the various blocks at ECB, as Lagarde speaks, what do they do with the acceleration of a higher German nominal yield?
German 10-year right now, just short of 135 at 133. Lisa, the growth outlook isn't getting better, it's getting worse. You heard from the World Bank yesterday. We heard from the OECD about 30 minutes ago.
Which is one reason why people think that perhaps the ECB will get a little bit of relief in terms of how much pressure they'll have to raise rates. However, there was that economic growth picture out of the Euro region and the economy there for the first quarter, and it was actually better than expected. So fuzzy data. How much are we looking at the Fed and the ECB hiking until something breaks, as Brian Weinstein was saying? And what does that look like?
What does it take to break something in the European economy, in the European debt market? Italy has got to be the one to watch. The Italian 10-year, the whole of the Italian bond market, can they take a whole rate hiking cycle from this ECB? Have you seen some of the numbers out there? Some of the estimates, Lisa, anywhere from 150 basis points, 200 basis points plus.
Are you surprised that we haven't seen something break more materially already in that market? Remember when people were saying that it was unlikely that we would ever see a move away from negative yielding debt simply because we have so much of it and it was the normalcy? We have shifted so dramatically and things haven't necessarily completely broken. How surprising is that? To me, it actually comes as a surprise. And how much further can they go probably depends also on how much economic momentum there is.
If you'd asked me 2 years ago, can the ECB hike interest rates in the next cycle, I would have said in the last one they didn't, and I imagine, Tom, they won't be able to this time either. This story's changed really quickly in the last couple of years.
There's a huge complexity going on. Of course, all of it centered around massive uncertainty on the war and, frankly, on food prices. And, wheat, corn today elevated for the first time in ages. Wheat actually with a bid as well. But, John, what's so important here is not to be inflammatory about the observation of yen or what's going on with the German 10-year, and just to say these are instabilities, and, to begin a theme as we go to Anastasia here after the brief, to begin with, it's overcome by events July, John. I think that's a new theme for me.
Looking ahead to next month, Tom, let's whip through the price action.
Yeah.
We're down about 0.4% on the S&P, on the Nasdaq 100, down 0.25%. Yields just a bit higher, up 3 basis points, 3% on a US 10-year. Crude at 120. 120, Lisa, up 1% on the session, and Goldman says a lot more still to come.
And how much will that really bleed into the picture for inflation and consumer strength, particularly in the United States? The week does start tomorrow and into Friday with that CPI report. Today, President Biden is heading to Los Angeles for the ninth summit of the Americas. Cuba, Venezuela, Nicaragua, all not invited. The key issue for me is how much are we going to talk about nearshoring, bringing some of the manufacturing production in Asia closer to home for the United States in order to get ahead of some of the disruptions that we've been seeing throughout the pandemic and in this current period. Today, Bloomberg Tech Summit is taking place in San Francisco, virtually as well as in person. We've got the CEOs of Uber, Expedia, MasterCard. I know that Tom is watching this very closely. He wants to know what to do with his triple leveraged all cash fund and whether there still is some growth in profits for the tech sector. And today, Russian Foreign Minister Sergei Lavrov is heading to Turkey for talks on unblocking Ukraine's grain exports. This is key. In the Black Sea, where about 90% of all grain, 98% of all grain from Ukraine typically has been exported. It has been blocked by Russia. People have been accusing Russia of holding this area hostage and for the world's food supply. How much are they really going to come to the table to negotiate, given the fact that Vladimir Putin has come out basically and said that the U.S. has to remove sanctions before they're willing to unblock some of these passages?
Yeah, but guys, what's great about this, and not to be inflammatory, I mean, it's Inflammatory Wednesday, but if Lavrov shows up at 17 lira to the dollar, does he leave when it's 18 lira to the dollar?
It's a good question, John. I'm going to pitch this over to you.
You're going to punt it back to me.
I'm going to punt that back to you. You can handle that one.
Thank you, Bramo.
Anytime.
Did you see the comments from Chancellor Merkel on Russia?
No, please.
Worried about isolating Putin.
She's been
This
quiet.
is the theme that I keep hearing about out of the European capitals. We're hearing it from the former Chancellor, Angela Merkel.
And
we
from
heard
Macron.
it from Macron over the weekend too, Tom. Just something to watch. Something to watch.
I think that as General Kimmett briefed us with General Hodges, they were dead on. There's an actual war going on, John. I've said this in phone calls and meetings. You get this conversation where it's almost like pretend war were removed.
I hear you, Tom.
It's not.
It's real.
It's like real folks. It's not,
kind of fallen off the front page in a way.
Yeah, it's not like a Hollywood movie. It's
I hear
like
you, Tom.
really, really bad. Why don't you get to our esteemed guest who's attuned to this?
Who's not going to talk about dollar lira? Anastasia Amoroso, the chief investment strategist at iCapital, joins us now. Anastasia, let's start here. You're looking for a soft-ish landing. Let's talk about the ish. Any evidence of that developing at the moment as you look at the incoming data?
Yeah, John, good to see you. I think there's a few things that I look at that give me a hope that we may actually have a wider path to a soft landing here. The first one is you look at the growth numbers. I mean, even with the OECD downgrading growth today, it's still a positive number. And if you look at the U.S., we're expecting 2.6% this year, 2% next year. This has not fallen off the cliff. It is still hanging in there. So yes, we're squarely in a slowdown part of this, but this doesn't yet have to be an imminent recession. You know, the second thing that I look at, and frankly, I've not been able to say that, yes, we have seen peak inflation and yes, this is it. But now I feel like there is more and more evidence building that maybe we are starting to see peak inflation. I mean, look at used car prices. They're starting to decline. Look at the businesses' intentions to continue raises prices. They just can't do it anymore. So more and more of them are saying we're going to pause. If you look at businesses' intentions to raise wages, they're pausing as well. So there's starting to be sort of a preponderance of evidence that maybe inflation is in fact easing. And this is commodities notwithstanding, but the other inflationary pressures seem to be easing. And then the third thing, John, that really gives me some confidence that maybe we can engineer a soft landing is the Fed is starting to sound a little bit more balanced. Yes, of course, they need to fight inflation, but maybe it doesn't have to only be by raising rates well into tightening territory. You know, maybe they can pause and let the high prices naturally bring down demand. So I think if they back away just in time, we might end up with a 94 scenario versus the 70s.
Anastasia, everyone wants to game out where we're heading right now. What does that mean for what you're actually buying? Because you have to come up with a thesis before we have all of the dots of what the Fed will or won't do and how the data is going to come in. How risk on are you right now?
Yeah, so it's all about the balance of risks. And I would say just a month or so ago, it seems like we have priced in a lot. We were already at that point, the equity markets were pricing in a 57% probability of recession. And now we've retraced some of that. Where I am today is I think we're trapped in a range. I always thought that 3,900 for this economic environment could sort of be the level of support. We seem to have bounced off that level. But at the same time, how much are you going to pay for $235 worth of earnings? 16.5 times is fair, maybe 17.5 times is fair, which is roughly where we are today, 4,100 on the S&P. But how much more do you push that? So I think, Tom, we are trapped in a range for now, but still there's some investment opportunities to look at. You know that I've liked technology, but one of the calls I have now is actually on financials.
You have it on financials, but part of this is the overarching theme, and that goes back to expect the unexpected. And I'm talking about overcome by events July. There's a mix of dynamics on the screen which are clearly out of sorts. What's the thing you're looking at for July that could be the unexpected?
Well, I think the big, I don't know if it's unexpected, Tom, but maybe it could still surprise us, is the commodity shock, right? Even though I'm saying the supply chain bottlenecks are easing and other inflationary pressures are easing, the commodity shortages are not going away.
I'm going to stop the show. You, more than anyone we know, have a visceral understanding of the coast of the Black Sea. You own the high ground on this. How do you respond to the idea that Odessa with one S or two S's could be shut down?
Look, this has a big implication for the commodity market. And, as I mentioned, the world is short of everything. The world is short of wheat, the world is short of grains, the world is short of oil and natural gas. To the extent that you close off that corridor, to the extent that the tensions continue to escalate and you can't get product out of that region, that is really, really tough. I mean, I think that's what people perhaps don't fully price in and don't appreciate. Commodity prices are up a lot this year. And, I think a lot of investors say, well, how much more do you chase that? But what people probably underappreciate is that we have a structural deficit of many of these commodities. So this is not just a tactical trade for this year, but this is longer lasting.
Such a good point. Anastasia, thank you. Anastasia Amoroso there of iCapital. And Tom, I think that something that maybe wasn't consensus a year ago is quickly becoming so. And that was the view of Christian Malik of JP Morgan Investment Bank over in Europe, Tom, when he talked about the lack of spare capacity in OPEC at the start of the year. And that felt kind of out of consensus. I tell you what, it's quickly becoming consensus for a lot of houses.
And on a microeconomic basis, JP Morgan's done a lot of great work here and others as well. Amrita Sen has been really wonderful on it. John, we don't even understand that when it is a normal hydrocarbon market, the supply and the demand is wicked tight. That's CFA talk, John. Wicked tight. Equilibrium point.
That's CFA Boston, Tom.
Yeah, wicked tight.
Without a doubt. 121 Brent, 120 WTI. Crude inching higher by 0.9%.
500 ball, Red Sox.
From New York. Are they doing better, Tom?
They couldn't do worse.
This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. So more problems for Credit Suisse. The Swiss lender has issued its sixth profit warning in 7 quarters. It expects a loss at the group-wide level and investment bank in the second quarter. Bloomberg has learned that Credit Suisse is considering a round of job cuts, part of a renewed push to cut costs. Here in the UK, Bloomberg understands that Boris Johnson will go ahead with the legislation to override parts of the Brexit deal. That risks inflaming tensions with members of his Conservative Party and with the European Union. The Prime Minister's government has been pushing to rewrite the Northern Ireland Protocol that keeps the region in the EU's single market while creating a customs border with the rest of the UK. The OECD says the world will pay a hefty price for the war in Ukraine. The organisation slashed its outlook for global growth this year from 4.5% to 3%, and it doubled its inflation forecast to nearly 9% for its 38 member countries. In San Francisco, residents voted to recall Progressive District Attorney Chesa Boudin. Boudin tried to reform the criminal justice system, but critics accused him of being too soft on crime. About 60% of those voting in favor want to oust him. He will be replaced by an interim district attorney chosen by the mayor, London Breed. And the son of the founder of Wall Walmart. Robert Walton is leading a group that has agreed to buy the National Football League's Denver Broncos. ESPN reports that the Walton Group offered almost $4.7 billion. That would be the highest amount ever paid for a U.S. professional sports team. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Leanne Gerrans. This is Bloomberg.
There's no question that we have huge inflation pressures, that inflation is really our top economic problem at this point, and that it's critical that we address it. So I do expect inflation to remain high, although I very much hope that it will be coming down now.
What did Paul Krugman say? Lisa, inflation hysteria of the media.
It's the media.
That was Secretary Yellen there of the Treasury. From New York City this morning, good morning. Futures negative on the S&P, down 0.25%. On the Nasdaq 100, down about 1/10. Off session lows. Yields higher by 3 basis points through 3% on a US 10-year. Tom Crude, 120.56, up by about 1%.
Hit a 122 print on Brent crude right now, 121.60. John, I think we got to go back to first principles on Friday, which is a hugely important look at CPI, and say that the top line CPI is grim, from 8.3 down to 8.2%, pretty much unched. But there's a demonstrable ebbing in core CPI. Maybe that will be the number to watch exactly at 8.
Month over month, Tom, without a doubt, for Wall Street, that's going to be the focus. For Main Street, it's everything else. And as you've said, Lisa said, I've said a million times, you can't eat or drink core CPI. And you certainly can't travel on it.
Let's get to a question that came up over dinner a couple nights ago. We can do this with Emily Wilkins in Washington. Emily, taxes vary state to state. Why are we waiting and taking a tax holiday?
I mean, a couple states, they are debating this in terms of taking a tax holiday from potential gas prices. But at the federal level, the main concern from Speaker Nancy Pelosi has really articulated this, is that if they were to take a holiday, it doesn't necessarily mean that these oil and gas companies are going to pass the profits down to the consumers. And there's additional concern that, these taxes are used to help fund highways. We just passed that major infrastructure bill, and they want to make sure there is funding there.
Dumb question of the morning. It goes to you, Emily Wilkins. Do the Democrats support, and frankly the Republicans, do they support our president traveling to Riyadh?
I mean, there definitely is some debate about exactly what Biden should be doing, how he should be engaging with the government there. I think it's one of those things where it's just the real politic is dominating the moment. The fact that everyone knows that gas prices are a high concern, trying to figure out what they can do. I mean, you've seen the Biden administration try to tap into the strategic reserve. You've seen Democrats kind of rail against various companies. You've seen measures tried to be moved, and yet you haven't seen much of a change in that price. And so I think there is a reality here that this is a global issue and that Biden will need to have global interactions to address it.
Is inflation really the center of gravity already in Washington, D.C.? We know it is outside of Washington, D.C. when you go and you talk to anybody or you go drive around. But it feels very kind of disparate in terms of the messages that we're getting from President Biden, who's currently heading to Los Angeles for a summit with North American partners.
I think that's because the White House has taken so many different messages as to explain inflation. They've tried to blame it on Putin. They've tried to blame it on the war in Ukraine. They've tried to blame it on major corporations. They've tried to blame it on the pandemic. And I'm not saying that there isn't truth in various pieces of that. But as far as one clear and consistent message, we've seen that more from Republicans who have simply been blaming Biden for it. And I think in D.C., one thing that lawmakers always like to say here is that they can walk and chew gum. There are multiple things going on at this point that are really dividing everyone's attention. Certainly, the gun debate is front and center in Congress this week. You mentioned that, Biden is looking at this conference of the Americas. That's certainly another thing on his plate as well. There's inflation to deal with. There's pricing. There's hopes that they can wind up passing something through reconciliation. So just a lot that is happening right now, and there isn't exactly one straight focus here in D.C.
Emily, for our international audience, and folks, we haven't done this too much international because in America, America on cable TV, the gun debate is 24/7. There's no question about that. What is the distinction right now of the quote-unquote gun debate, Ms. Wilkins?
Well, at this point, all eyes are on the Senate, where negotiations are happening between Democrat Chris Murphy and Republican John Cornyn. And Cornyn's really the linchpin on this, because we all know there are many Republicans out there who would be perfectly fine keeping the status quo as is. But, Cornyn's from Texas. He has that connection to Uvalde, and he is trying to get something through.
Emily, what are they going to do to stop the X number of people who will be killed between now and 6 a.m. Monday morning? Is there anything in the legislation to give hope to that concept?
The one thing that they really seem to be pushing right now, that gun advocates as well have been urging for, are these so-called red flag laws, this temporary removal of guns from those who have deemed a danger to themselves or others. But at this point, there doesn't even seem to be a federal law in the works. What it seems is that the federal government is going to try to encourage states to take up these own laws through a grant program. And we've seen more than a dozen states take up these laws already, including in some places like Florida, some of these red states. But at this point, that really seems to be as much as they want to do in terms of gun control. We're expecting to see some more on mental health, some more on school safety. But really, at this point, it is still a very, very difficult issue, even given how heartbreaking and tragic some of the recent mass shootings have been.
Emily Wilkins, thank you. Down in D.C. Lisa, on several fronts, you hope that we can achieve something on the policy front. Going into the midterms, it just feels like we probably won't.
I see no policy prescription right now on the table. There's a blame game, a massive blame game, with people saying it's somebody else's fault on all sides. Perhaps the Republicans are getting more traction with it because it's a cleaner message than the Democrats, and that's simply what you're getting. Beyond that, what are we looking for in terms of a Democrat or Republican win, and what the policy implications of that will be? That also not very clear to me.
Something to focus on through the next several months going into the back end of this year. Let's start here with the equity market. We're down about 1/3 of 1% on the S&P, on the Nasdaq 100, down about 1/10 of 1%. No real drama in the equity market this morning, at least. It's a quiet morning. In the bond market, too, to some degree. Yields higher by 3 basis points. But in foreign exchange, Tom, we just keep going back to it. I know actually at the moment it's the first thing you look at. It's dollar yen, the first thing you look at in the morning, through 134 briefly earlier this morning.
You look at Euro-Yen complex, Aussie Yen is frankly just as important with our American centricity. But I also look at a lot of the other pairs, John, in the blended indices. The fact is DXY and the Bloomberg Dollar Index, which is better math, the fact is they really haven't broken out to new dollar strength. And that's a raging debate among currency pros.
Tom, looking forward to a conversation coming up with Bob Miller of BlackRock. We'll do that in just a moment. Lisa, we've got a lot to talk about in this bond market with yields breaking out over the last couple of weeks.
Yeah, although stasis right now. Are people basically believing that the Fed is going to move just enough? Is basically the idea of a soft landing or a soft-ish landing now becoming more on the page? How much is peak recession fears kind of a little bit past us?
Futures negative 1/4 of 1% on the S&P, on the Nasdaq 100 down 1/10 of 1%. On that particular conversation, Lisa, I could probably run with that. This idea that maybe we've seen this mechanical peak, which is the point that Paul Krugman was trying to make a little bit earlier.
Inflation's still the main problem facing the U.S. economy. Janet Yellen's words, not mine.
Without a doubt. Yields higher by 3 or 4 basis points, 3.01% on a 10-year. From New York, this is Bloomberg. No drama this morning. Good morning. No drama, at least so far. Equity futures down 1/4 of 1% off the lows on the S&P. On the Nasdaq 100 down by about 1/10 of 1%. The OECD cutting their outlook to about 3% for global growth. That's not news, is it? That's confirming what we've already heard from a lot of other places, including the World Bank yesterday, looking for 2.9%. That's the equity market. Here's the bond market worldwide. I want to talk about this. Easy to spot the difference here, isn't it? Which one is the odd one out? Looking at the US 10-year, the German 10-year and the Japanese 10-year. Yields up in the US, yields higher over in Germany, 135 on a 10-year bund, and almost totally unchanged at 25 basis points in Japan. The why? because the BOJ is trying to cap it there. And as they do that, as they try and cap bond yields at 25 basis points, remain committed to not hiking interest rates, whilst the latter two central banks, the ECB and the Federal Reserve, look at making a continued move through the rest of this year. This is what happens through the FX market. You push this through foreign exchange, the Japanese yen has to take all the pain. Dollar yen breaking out again. 135, Tom, on dollar yen in sight after briefly breaking 134.
It's a lot of dynamics there, and we'll be looking at that, and of course, for the coverage of the ECB tomorrow. It will, I'm sorry, John. It's all of a sudden ever huger deal with frankly Pacific Rim ramifications.
I had someone message me this morning about the ECB, Bramo, and they basically just said, "Are you serious? I cannot believe they're not hiking tomorrow. What's this about? Laying the groundwork for future meetings. Let's go."
We were talking about this in the break. Why not, right? Why not just raise 25 basis points? Forget 50 basis points. Just get ahead of it. If you're going to talk about doing something and the need to do something, what is holding them back? And you pointed out that it was the peripheral yield market, that they're concerned about disrupting Italy, as well as Spain and Portugal and Greece. I mean, all the other countries. How much can they continue to do this? Because at some point, they've got to rock the boat to get some sort of tightening that is required for the inflation that they currently have.
Trying to hold the market's hand in a way the Fed is not. Key difference, though, the labour market in the US stronger than the labour market in Europe, may be allowing them, Lisa, just to go a little bit harder here in the States.
Yes, although they have to do something. So when does hand-holding become counterproductive and actually go against the end goal? How do they get around that? And what other policy prescriptions, supportive perhaps for the Italian, the Portuguese, the Spanish, the Greek bond markets, could they come out with?
Do you remember when President Lagarde said she wasn't there to close spreads?
You loved that. You just nailed on that. You were like, nah,
just
next day. We're here to close
was it even
spreads.
the next day?
We're here to close
I think it was
spreads.
hours later.
Yes.
Let's make a quick interview with someone we like so they're kind to us and we get to say what we want to say. Talk about that another time. That's your cross-asset price action. Let's get you some single names, some stock movers. We can do that with Romain. Morning, Romain.
Hey, good morning, John. Of course, back here in the U.S., all eyes still focused in on consumer spending. We did get Campbell Soup earnings just a little bit earlier this morning here. They were actually pretty good, at least on the overall numbers, but it was an interesting mix here. Total sales were up about 7 to 9%, depending on the category. However, you actually saw a decline in the volume of sales here. Now, Campbell made up for that with a 3% decline in volume across the board. They made up for that with roughly about a 10 to 12% increase in prices. So an interesting mix here of a company that does, at least for now, showing a little bit of pricing power, though is also making clear that, at least on a volume basis, things have tamped down a little bit. Nevertheless, Campbell shares up about 5% here in the pre-market. Meanwhile, and also in the consumer space, you have Affirm. Those shares down about 4% in the pre-market. And we know they got battered around on Monday because of that entry of Apple into the buy now, pay later space. But there's a broader issue going on with Affirm, and it's highlighted in a wonderful Bloomberg story today about some of the securitizations that Affirm has issued, where it repackages those loans, and the prices of those, of the existing ones, have started to fall. And of course, any new issuance that this company comes to the table with, they're having to pay more, basically offer a little bit more yield. This is a big concern now. Remember, the business model for Affirm is way different from the other buy now, pay later companies that actually finance themselves primarily through debt or customer deposits. So keep an eye on that space. Remember, this is a stock already down 70% from its all-time high. And then there is still a focus on business spending. Smartsheet came out with earnings. This is a big software company. They beat on a lot of the top line numbers, but there was a deceleration in growth that has some folks concerned. Those shares down 6%. And then we heard from Intel the other day, a lot of the company's management, they were at a conference there, and according to Citi analysts, they said the mood was actually pretty dour. They were talking about a lot of challenges ahead. Intel shares down about 3%. Meanwhile, DocuSign, a big pandemic darling, they're actually reaffirming their partnership that they've had with Microsoft. That's giving them a little bit of a lift. DocuSign shares up about 5% on the day. And, well, the pandemic is sort of over, but Novavax finally getting its vaccine potentially to the U.S. market. An FDA advisory panel yesterday, Tom, did finally sign off on that. They still need full FDA approval, but those shares up 10% here in the pre-market.
Romain Bostic, thank you so much. The close coming up this afternoon as well. This is the conversation today. If you've opened up the proverbial envelope and looked at your bond portfolio and said, ooh, price down, yield up. Bob Miller, head of America's fundamental fixed income at BlackRock, has decades of experience looking at that. He's younger than me. Long ago, he was with the Davidson Wildcats getting things done, and I was enjoying the last time we had a bond market like this, which was 78, 79 Volcker. Bob, what do you do to claw back to 2025? What is the attitude you take where you're down 10%, 13%, 16%, 4 years coupon, and I got to claw back out 3 years. What's the strategy?
Great question, Tom. You know, the interesting thing is there is some value that's starting to be created in the U.S. fixed income market. Let's just stay there for the time being.
Please.
You know, at wider spreads recently, some of the spread products, you know, whether it's securitized CMBS, CLO, et cetera, or even high yield and the you know BBB IG stuff started to look reasonable. Now, spreads snapped in pretty aggressively in the last couple of weeks. I wouldn't be surprised if we get another bite at the apple, but at these forward rates in treasuries, you know, we think rates probably go a bit higher. Specifically out in the term structure of rates probably goes a bit higher, but we're starting to get to levels where you can build a portfolio that probably earns, you know, 3 to 4, maybe even 5% in a certain scenario over the next couple of years.
Of the Frank Fabozzi,
so it's plausible to get it back.
Of the Frank Fabozzi variables, can you extend duration? That seems to be the biggest risk right now.
So that's a tricky one, right? I think the consensus view is yes, that for a reason that I agree with, which is treasuries now do have some portfolio hedge capabilities or properties, which they didn't have a year ago or 2 years ago because the levels were so low, the yield levels were so low. So yes, in an absolute crisis, treasuries are going to rally a lot from these valuations, but I'm in the camp that thinks there are a number of longer term, more secular, perhaps, influences that are likely going to work to push the term structure of rates a bit higher over the next couple of years. Things like all of the, 2 of the 3 G3 central banks abandoning QE and the Fed now starting to allow runoff. Things like Europe pursuing energy and security independence will require a tremendous amount of investment / borrowing. If the world actually does become genuinely motivated to pursue net zero, that's going to require a massive CapEx program around the world over a couple of decades. That will likely lead to a higher term structure of rates. So there are a number of things that kind of lean in that direction. They're not near-term catalysts at all, but I think the term structure could probably, I think we could have a steeper curve for the same level of inflation and same level of growth over the next couple of years.
Bob, early this year, people looked every morning at the Fed funds futures and when the Fed would raise rates, what the things were gamed out, how much rate fear was there currently in the market. We've shifted. Now people are looking at economic indicators, and it's less about the Fed parlor game, as Tom likes to say, but more about the fundamentals, some of the secular changes that you're talking about, as well as whether the U.S. economy is accelerating or actually experiencing certain stagflationary types of dynamics. What do you look at every morning when you come out with a near-term and a mid-term view of those yields?
So, you know, Lisa, the tricky thing is that financial conditions in the U.S. have tightened a fair amount. You know, the impulse, the magnitude of tightening from very accommodative levels is sizable on a historical basis. So it's possible that FCI, that financial conditions have tightened enough to allow the Fed to achieve its target with respect to inflation. The challenge is you actually have to deliver the forwards in order to get that tightening, right? So or it has to come through other channels that are less favorable. So the forwards, as you said, are priced for very specifically for 350s and 225s over the next 5 meetings. I think that's probably sufficient, and we're also priced for a 3.25 terminal rate a year from now. That may well be sufficient. It's just that you've actually got to deliver that in order to get there. So the vol in the U.S. has started to come down, and that's probably a durable trend. It's not going to collapse, but realized and implied volatility has started to come down because we've kind of settled into, as you said at the beginning or when we were talking before the show, we've settled into a little bit of fatigue with respect to the Fed, and the forwards seem pretty fairly priced for what we know today.
It's the part of the conversation we should take live to air. Just Lisa in the commercial break telling the world what she really thinks about everything. If you thought the stuff on air, was punchy, the stuff in the commercial break is so much better. Bob Miller, thank you, sir, of BlackRock. I caught up with Rick Reeder of BlackRock on Friday, and something he said has just stayed with me over the weekend and into this week as well. Just turned around off the back of the payrolls report and just said, John, that's the last strong one. I think that's the last strong one. And Tom, perhaps a negative
Yeah,
print
well, this
is in our
is-
near future. That was the take from Rick Reeder over at BlackRock.
This bet is out there. And let me say, John, I have an immense respect for people in equities and bonds that actually have to run money. There was way more discussion of the bond bear market at the end of the 70s into Volcker than there is now. There's like this secret, this is just going to go away somehow.
Totally.
And the fact is, I'm looking on the Bloomberg at R squared's way above 0.90, sharp ratios that are unmeasurable, and I'm sorry, double-digit losses in bonds with coupons of 4%. And we're not talking about it.
Tom, that sentiment that it's just going to go away, I think that extends to so many things at the moment.
Yeah.
I think a lot of people would watch this program and say, oh, it's so gloomy. Most of the guests still believe the Fed backs away by the end of the year.
Well, yeah, okay.
That's the
Mrs. Keene was
consensus
hoping I
view.
would just go away.
Is she still hoping?
She's still
Will she get her
hoping.
way?
She's
got to stick with this
still
one, Tom.
Let's
Make this one work. Futures down.
Oh,
0.2%.
Yeah.
This is Bloomberg.
At least my sweatshirt's fit.
True.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Credit Suisse is considering a round of job cuts after warning of a second quarter loss. Bloomberg has learnt the cuts would be spread across divisions, including investment banking and wealth management. It was Credit Suisse's sixth profit warning in the last 7 quarters. Over in LA, a billionaire developer will take on a veteran politician in the race for mayor. Rick Caruso will face Congresswoman Karen Bass in November. Caruso won 41% of the votes in yesterday's primary, while Bass won 38%. Both are Democrats, although Caruso is a former Republican who did not switch parties until January. Western Digital has announced a strategic review that could result in the separation of its 2 businesses. The announcement came after weeks of talks with activist investor Elliott Investment Management and other shareholders. Western Digital is one of the world's largest makers of a type of chip called flash memory. It also makes hard disk drives. Shares of Novavax are soaring in pre-market trading. The company's coronavirus vaccine has won approval from a U.S. Food and Drug Administration advisory panel. Analysts say that it is good for the shot's chances of gaining emergency use authorization. And do you know what the most expensive city in the world to live in as an expat is? So for the second year in a row, that is Hong Kong. Now that's according to the ECA International. Higher prices and a stronger currency kept the city at the top. New York, Geneva, London and Tokyo round out the top 5. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
When oil prices move away from where they've been for a while, when they get salient in household decisions, when they really get your attention, that's when they matter for economic activity. And guess what? We're long past that point. Yeah. It is number one concern among households. It's got to be crimping household spending.
We're a long way past that point. Vincent Reinhardt there, the chief economist at Dreyfus and Mellon. He was fantastic, Tom. With Tom Keene, Lisa Abramowicz and Jonathan Ferro, this is Bloomberg Surveillance. Your equity market looks like this. We're negative on the S&P just a bit, down 0.2%. On the Nasdaq, a little less. We're down 0.1%. Yields higher by 3 or 4 basis points. Back through 3%, 3.01%. Crude, WTI with a 120 handle. 120, spot 63, up more than 1% on the session. Year to date, up 60% on WTI, on Brent up 56.5. Citigroup making some adjustments coming into a brand new trading week, Tom. Over the weekend into Monday, they raised their second quarter Brent crude forecast by $14 to $113, their third quarter estimate by $12 to $99, and their fourth quarter forecast by $12 to $85. That 4Q, Tom, compare the 85 at Citi to where Goldman are at. That is a wide spread still between the two.
This is the privilege that we have, not only working with Javier Blas, Will Kennedy, and all of Bloomberg hydrocarbons and commodity coverage, but also digging deep into the analysis of global thinkers. The giant of all this is Edward Morse with Daniel Yergin, separate, looking at the global macro moment of this commodity boom. He is global head of commodities at Citigroup, and as John says, has a bit of an outlier call right now. Ed Morse, how do we migrate back to your oil fundamentals under $90 a barrel. What are the trigger points or catalysts that break the ascent of oil?
So the catalysts really are very simple. They're called supply and demand. And we've got to get through the next few weeks to see whether there actually is going to be a driving season this summer. But underlying the differences of view is really what we think is raising prices now. And what we think are raising prices now are the dislocations that have occurred as a result of countries and companies refusing to take on Russian oil. There's no easy substitute for Urals. We're not in a one oil pricing system. Right. We're in a two oil pricing system. And we have to remember that while WTI may be at 120 or Brent may be at 120 something, Urals is trading at 30% lower than that. So it's not one clear market. And it's the disruption of that lower price that we have to think about and ask why we have these higher prices.
And I'm going to just say that we're planning a trip, Lisa, John, and I, to Abu Dhabi. And, of course, we're going to have an oil summit there. And we're going to have on stage Francisco Blanch, Christian Malik of J.P. Morgan, Blanch of Bank of America, you and other worthies. And the singular distinction seems to be the guess that hydrocarbon investment will or will not come on. If we get higher oil prices, are you more optimistic than others that investment will materialize?
Well, I think for starters, I don't think there's that problem. I think we have more than enough investment in hydrocarbons. I think we have a problem in the hydrocarbon world in that the United States, the short cycle big guy, has lost a lot of oil production. The U.S. was producing, we have to remember, 13 million barrels a day in March of 2020. It went down to 10.2 million a day. It's now at 11.9 million a day. It's well below where it was and where it would have been had we not had that drop in drilling. We would have been at 14.5 million barrels a day, and there would not be this problem. We have more than enough spending into oil and gas finding and development. It's shifted a little bit, but if we look at the next 2 or 3 years and compare expectations of demand and supply, we think the market is oversupplied.
Ed, have you seen any signs that demand is starting to cool for driving, for flying, that gives you confidence that perhaps we might not see the driving season that some people are expecting?
Well, we actually were trying to observe that, and we decided to look at not only the 4-week average at this time of year for gasoline and diesel demand in the United States, and we went back and discovered at first glance that it was the lowest it's been in 5 years, other than in that big year of 2020 when demand collapsed completely. We've now gone back 10 years to find a time when demand for gasoline and diesel were as low as it is, and we had to go back to 2012, 2013. So if we think the EIA weekly data have a semblance of reality to it, gasoline demand is down year on year, diesel demand is down year on year, and it's the lowest it's been for a decade. And that's a sign that the price of oil has had an impact on where demand is going in what still is the biggest oil-consuming country in the world.
So, Ed, why did you end up shifting your expectations, your forecasts higher, if you still hold to that conviction that we might not see the driving season that a lot of people are saying we will?
Well, we drove prices higher, first of all, to market. We had second quarter results that are marking it to market higher than where we were at. And we try to figure out what was really happening. What was really happening was that companies and countries were forswearing Russian crude. They could find no substitute for it. So they had to bid up the availability of light, sweet crude in the world that is not the same as Urals. They bid it up from the country that has the most amount of this, namely the U.S. with our open borders. And the fact of the matter is that U.S. exports have been booming. Our combined exports of crude oil and petroleum products in recent weeks have been at the 10.5 million barrel a day range. That would make the U.S. the largest liquids provider in the world, bigger than Russia, bigger than Saudi Arabia. That's up by a couple of million barrels a day from where we were. So when companies had to look away from Russia for diesel, where did they go? They went to the U.S. When companies had to look for crude oil, where did they go? They came to the U.S. And our inventories came down, giving a misleading impression that the whole world was going down in the inventory side the same way the U.S. is.
Just quickly, and I've only got a minute, and this deserves a much longer conversation, of course. How sustainable do you think that is politically? Because I don't think those numbers are that well known outside of conversations like this one.
Well, I agree with you. If it became political, people would start talking about stopping the exports, just as they talked about stopping the exports of natural gas. So it could be politicized in a way that it would be in an election year, with gasoline prices being as important as they are.
Ed Morse, thank you, sir. As always, of Citigroup, refreshing just to have someone say, we're market to market. Lisa, that's what we had to do. And looking at the spread through 4Q, and I think that's where the debate lies now, the difference between Citi and, say, Goldman. Citi at 85 in the fourth quarter on Brent. Tom, Goldman at 130.
These are huge decisions, and they're said with respect. We don't have an opinion on this, John, but I really can't say enough about in their lengthy reports, 20 pages, 40 pages, indeed 100 pages. They lay out a theory underlined by supply and demand, and that's the heart of the matter, is Marshallian supply and demand of oil. That's been the battle from day one.
Tom, what did you make of those crude product export numbers that Ed just went through?
Ed is talking about the success of the American Energy Project. I was with Spencer Abraham the day the energy policy of America went down in flames. With that energy policy, lack thereof, we have a huge export market, particularly of distillates.
How politicized does that get as the year progresses? Right now, futures down a third on the S&P, on the Nasdaq 100 down 0.25%.
Where are we going to be in 6 months?
$6 gas, according to JP Morgan, maybe at the end of the summer. Tom, unreal numbers out there at the moment. From New York City, this is Bloomberg.
I think the Fed has a lot of catch up to play.
Ultimately, what the Fed is trying to do here is achieve that elusive soft landing.
It does seem like the odds of a soft landing are reasonably good.
The risk obviously here is inflation.
Our view at the moment is that we avoid recession, but that probably means that the Fed stops much sooner than markets thinking.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television on Wednesday before Friday CPI. But we got to get there first. And tomorrow, John, ECB with some tough decisions given what Italian paper is telling us.
Without a doubt, Tom, they've got to clarify the road ahead, the path ahead through the rest of 22 and perhaps into 23, laying the groundwork for something we haven't seen from an ECB since 2011. Tom, an interest rate hike just around the corner.
It's around the corner, but I mean, it's definitely a road trip to Milan for the three of us. I mean, we've got to talk about what does the tea leaf of Italian paper mean away from what's going on with the German 10-year and the Japanese yen. John, what is the signal you take from Italian
Tom,
paper?
This is the signal I take from you. Why don't we just do a European tour? Let's go across the whole periphery. We'll go from Italy to Greece as well.
You thought you'd never ask.
Look, for me at the moment, the Fed's made a move, but the Fed made a move last time around on its own. The ECB didn't come along for the ride. The BOJ didn't come along for the ride. This is different. The ECB is going to come along for the ride. I have no idea how long that ride is going to last, but they're going to try. The BOJ, Tom, is trying to do something they did before. Wait, sit it out, and you're seeing what's happening in the FX market consequently.
We'll get to the data here in a moment. Weaker yen through the 134 print as well. That is earth-shaking. Let's keep this thing going, Lisa, on Italian paper, and it speaks to not full faith in credit, but the idea of the mix of the bond market. I'm sorry, it's price down, yield up.
Why isn't it yield further up for those Italian bond yields? Because the ECB has had the back of the peripheral markets for so long. How do they thread this needle? How do they support the areas that are most at risk while also allowing a tighter financial monetary policy at a time of such high inflation? They got to do something. And this is the shift in the dynamic right now, Tom. Central banks have a different calculus than they've had for the past decade or more. And this is going to be a very difficult period, which is the reason why people are pricing in so much higher yields.
In bank-to-bank there, Lisa, your view of Friday's CPI and particularly core CPI that Paul Krugman looks at.
I'm less interested in the headline numbers. I want to see underneath how much there is some sort of gains within the rental markets. I want to see what there is in terms of the gas component, what there is in disposable spending, in experiences. How much does the consumer start to pull back, and what that means for both inflation as well as growth?
John, the real yield solid. I know you're beginning planning for your Friday real yield show with your team.
It won't be a Friday, but someone else is planning, Tom.
It's not me, is it?
It's you.
No.
You're going to do it. CPI special, Friday, 1 p.m. Eastern. Everyone's excited now. I've called it. That's it. You're filling in. Yes, confirmed.
Tom's about
just
to
now.
walk off set.
1
He
p.m.
complained.
Eastern Time, Bloomberg real yield with TK following CPI
No,
on
my
Friday.
people have not.
The big look ahead.
This has not
for
been
the Federal
cleared by
Reserve next week.
This has not been cleared by my scheduler, John. I'm going to start with 0.24%
Sure.
on the 10-year real yield. It's like a rock.
I'm going to pick up on what Lisa just said. There's a shift here from goods to services from the consumer. Target speaks to that story. Target has now got a bunch of inventory, all these goods that they've got to shout down. So what we could see is a disinflationary impact on the goods side, but offset by what happens on the services side. Tom, when you put it all together, what does that mean for the rest of the year? Does the labour market continue to have this tightness and push inflation even higher through the rest of this year? That's the view of Citi. It's not the view of everyone.
Sorry, John. I was sipping some Tang there, just trying to keep
Speaking to your team,
going
keeping
here.
it together ahead
John,
of
on the
Friday.
data check here, I'm
It'll be
sorry.
okay.
The dynamics here, John, for pros, there's some serious rates of change going on right now.
Sure, let's start with stocks. Not much happening, no drama, down 1/3 of 1%. Let's
Nice
go to
recovery
bonds.
yesterday.
Yields higher on a 10-year. Nice move, wasn't it, Tom? 3% on a 10-year. Yields higher by 3
That was
basis
not me
points.
initially,
It's a
but
nice
carry
move,
on.
Bramo. Great. German 10-year yield higher as well. What's missing here, the missing piece of this move in the core government bond market, Japan. And as Lisa has pointed out many times, I'm not even sure we can call it a market anymore. Not a single 10-year JGB traded yesterday. JGB yields are pinned at 25 basis points. Where are you going to push? You make that push in the FX market. Dollar yen, Tom, 134 earlier this morning.
In these stresses, you have to sum them together to a cogent idea of what to do with your money. It's been a terrible 2022 for that. Lots of losses taken. Beata Kerr joins us now, co-head of investment strategy at Bernstein Private Wealth. Beata, what is the new strategy, the amendment, the distinction right now for Sanford Bernstein?
Well, thank you for the question. At Bernstein, we've been thinking about the trade-off between stocks and bonds and alternative asset classes for quite some time, and this market has obviously posed some unique challenges. Talking about the increased correlation between bonds and stocks this year has been an extraordinary challenge. But what we see today is real opportunity in the high quality, intermediate duration municipal space. You were talking about it earlier. Yields are up, and they are up to levels that we have not seen in an extended period of time. So we think a lot of the selling pressure that we saw in the first quarter on the bond market is going to ease as we come into the summer. And the tax equivalent yields that we're seeing in this asset class today are really starting to approach almost 5%. So we see an attractive entry point for people that are in cash into that high quality intermediate duration municipal market.
Beata, where does it leave credit, corporate credit?
Well, we actually see quality in corporate credit. And when you look at the credit markets broadly, including high yield, because our base case is a mid-cycle slowdown and not a recession, certainly in the next 12 months, that is our base case, we're okay leaning into credit, including high yield. So being active in today's bond market is even more critical than ever. So we like credit as well.
Beata, how do you brush off some of the threats from Deutsche Bank's credit team that just put out this report that we're going to see a default cycle unlike what we've seen over the past decade, that we're going to see defaults seriously pick up probably around 2024 as we do get slower growth and given the glut of debt that a lot of these companies have incurred?
Well, I haven't seen their report, but what I can tell you is that our fixed income portfolio managers are managing the portfolios for today. What's happening in a cycle in 2024 is not the market's current concern. What we have been handed today is yields that are substantially higher than we've seen in practically a decade. And today, of course, we're going to be all eyes on the CPI report on Friday and continuing to measure that output versus the growth that we see. And our base case remains a mid-cycle slowdown. And that means that we don't see a tremendous increase in defaults. In fact, we see corporate balance sheets that are still really high quality. And we see a consumer who has net positive wage growth and entered this cycle with very strong balance sheets as well. So there's clearly vulnerability on price, but it's something that we're going to keep a close eye on, and that CPI number is going to be instructive this week.
Forgive me, that's exactly where I wanted to go. CPI, what aspects of it are you looking for? How are you going to use it as an instruction tool ahead?
Well, you were actually talking about it right before I came on, this balance between goods and services. That is the story of the year. It's going to be the story of Friday. We do see some moderation in the number likely to come. And the biggest moderation we think is likely to come from the housing market. With mortgage rates over 5% now, the highest number that we've seen in a decade, we have already started to see signs both in the price number as well as mortgage applications and refis. So eventually that's going to make its way over into owner equivalent rents, the biggest component in the services area. And that transition, we hope, from goods ultimately peaking to some moderation in services will take some time. But we're going to be looking for evidence of all of that on Friday's report.
So you think there could be some downside risk to the print on Friday, correct?
Well, we think we're optimistic that we've seen a peak. We're not calling a peak in the CPI, but we think we could start to see some early signs of that starting to ease.
With that in mind, what's the balance of risk around how the market will respond to it? Is it asymmetric? Do you think there's more upside to the market based on what we could get from a downside print relative to downside of the market from what we could get from an upside print?
Well, the equity markets today have really been pricing in risk at a high level. This drumbeat and chorus of recession risks over the last quarter has been driving the downside in the market. But what we see in the market in terms of earnings outcomes is actually much more positive than what the market has implied in terms of price. We've got a U.S. equity market today trading at about 17 times earnings for end of year. That's 4 points lower than where we started the year. So honestly, we think the equity market is going to be looking for direction in terms of positive momentum on that inflation change.
Bjarke, thank you. As always, awesome. Bernstein, Private Wealth Management, into Friday, looking ahead to inflation. Just to give you the numbers, Wall Street's going to focus a lot on that core month-over-month figure. The estimate so far, Tom, 0.5% in our survey. That's down from 0.6%. I think a lot of the country, though, is going to be very focused on that year-over-year headline figure. That's what you hear about in a lot of the news. That, Tom, the estimate, 8.2%, just a little drop lower from 8.3%. All that can change in the next few days, of course, but that's the survey so far.
Yeah, I'd go like David Rosenberg up in Toronto and parse it out and see what it is. Lisa mentioned that earlier, the subdivisions of inflation really matter. John, we've been sort of non-equity today, and I really want to mention the lift we saw in equity yesterday afternoon, and Alice Sanford Bernstein and Beata just there. The calculation of free cash flow forward out of these shocks, including the inventory battle, moving from just-in-time to just-in-case inventories through the pandemic, the analysis of what free cash flow is going to do into the end of the year and into next year, to me, is a massive mystery.
And Tom, you've got to pay attention to how the market responds to that incoming information. Target closed lower, but only by 2.3% yesterday.
You called that.
I think it's notable. Well, I raised the question. I wouldn't say I called it.
No, you totally did. You said that interesting people see where it ended.
Ramo, if I was wrong, I wouldn't have mentioned it.
I know exactly. So you could just take a victory lap. Come on, go ahead.
No victory laps.
Okay.
No
You were
victory
out
laps.
of you at 8:40 a.m. yesterday. You were buying out of the money Target.
Let's behave. Tom, I've just got a message. Lisa and I both got the same one. TK's Unreal Yield on Friday. Just a bit of a rebrand. And let's see, you could own this one into the summer. I'll do summer Fridays for the rest of the summer. And you can do TK's Unreal Yield at 1 p.m. Eastern Time.
Everyone can watch.
You've gone so quiet. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. More problems for Credit Suisse. A Swiss lender has issued its sixth profit warning in 7 quarters. It expects a loss at the group-wide level and investment bank in the second quarter. Bloomberg has learned that Credit Suisse is considering a round of job cuts, part of a renewed push to cut costs. The OECD says the world will pay a hefty price for the war in Ukraine. The organization slashed its outlook for global growth this year from 4.5% to 3%, and it doubled its inflation forecast to nearly 9% for its 38 member countries. It is a widely awaited study on the Omicron variant that could pave the way for another round of boosters in the fall. Moderna has said its COVID vaccine that targets Omicron generated a superior immune response against the variant compared to its original shot. The trial is one of the first to examine whether Omicron vaccines may offer better protection against the strain. In San Francisco, residents voted to recall progressive district attorney Chesa Boudin. Boudin tried to reform the criminal justice system, but critics accused him of being too soft on crime. About 60% of those voted favored ousting him. He will be replaced by an interim district attorney chosen by the Mayor London Breed. Global news 24 hours a day on air and on Bloomberg Quick Take. powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
For the Fed, I think that they recognize, look, they are missing on their inflation mandate. They need to get that under control. They're going to be hiking reasonably aggressively at least the next two meetings, and then probably guiding the market to expect further rate hikes.
Market banner there of Bank of America from New York City this morning. Good morning. Futures lower by 1/3% on the S&P, and the Nasdaq 100 down 1/3% also. Special programming announcement coming up on Friday, 1 p.m. Eastern time. I've got a team to make the graphic, Tom. There we go. TK's Unreal Yield coming up at 1 p.m.
That photo,
Eastern time.
Nixon was president when that photo was
That was
taken.
a special photo, Tom. You know, just to encourage you, the big debut coming up on Friday. And
for
through
those
the
of you on
summer,
radio, you're
until Labor Day, this will be every single Friday at 1 p.m. Eastern time.
He's going to walk off set.
As I just get a bit of rest and get ready for the end of the year, Tom.
Okay, we're going to talk economics right now and save the show. But first, with David Blanchflower of Dartmouth College, I must ask, Page is out saying that Gareth has to play regular games to get to the World Cup for Wales. I mean, it sounds to me like he's destined for Cardiff. What do you think?
Sounds like it. We survived this year, but Wales into the World Cup seems quite a big deal.
Are you willing to donate some money here for Cardiff to play the big ticket for Mr. Bale versus going to the Tots?
He sounds pretty expensive to me. You and we'll send him $20.
Yeah, John, pick it up here. You know.
Oh, you want me to get us out of this?
Yeah. Well, you know, that's the only reason I had
Danny,
Blanchflower
let's
to
start
talk
here.
about Cardiff.
I think where you've been tremendous over the last 10, 15 years, particularly, is to provide this different perspective to the consensus view. You did that in the previous cycle with the labour market. Everyone used to talk about a tight labour market. And by the time we got to the end of that cycle, a lot of people looked back and said, maybe not. You're trying to do that again. I wanted to start with the data point, and that was the amount of credit, the amount of borrowing that consumers are making at the moment. What do you make of that, and what does it speak to?
Well, obviously, the starting point is mortgages are now obviously pretty high, and we're seeing slowing in applications, and presumably we're seeing slowing in that housing market. I mean, the other part of it is presumably what we're seeing are people being stretched. And you might expect as they're being stretched that they resort to credit cards and, trying to pay the bills as they go. So I'm not exactly sure what to make of it. I mean, I think the answer is that, down the road, we're probably going to see some defaults. But I think your point is good in the sense that much of the discussion that I hear is really quite unbalanced. I mean, we're hearing all the conversation about the Fed's going to, the last commentator, the Fed's going to do two rate rises and so on. Well, that's fine. It really depends, however, on the data. And I think, something that really sets us going is the OECD forecast this morning, which again, to me, looks really too optimistic. But they cut the global growth forecast from 4.5 to 3. And it certainly looks to be too optimistic. So I think the evidence going here is that, we're going to wait and we're going to look at the data. But I think everyone seems to be saying the same thing. And there's a clearly credible argument to make that output is going to slow much quicker than you think. It's time to sit and watch and wait. And essentially, that's the position that the ECB and the Bank of Japan have taken. So I don't think we've seen a very balanced discussion. I'm not saying I'm right.
Danny.
But I think, go, Lisa.
Let's just clarify this for a second. What is the correct policy prescription in your view? Is it to not raise rates at all anymore in the Fed, by the Fed?
No, I think the answer is that we really have no idea. We have no historical precedent on what to do. There's no data points. Perhaps the only data points we have are 2008 and 1929. And so we really have to be dependent on a set of scenarios. Scenario one is inflation keeps rising. Scenario two is COVID moves onwards. Scenario three is output collapses. People start to default on things. Depending upon those sets of scenarios, we would have to respond. The Fed has to say we're dependent on the data. And my view is that it's perfectly feasible to argue right now that rate cuts are on the table. I mean, one possibility is they're on the table. We'll sit and we'll wait and we'll watch. but suddenly some bad data comes and all the commentators saying they're going to raise X times and so on, and we know what's coming, and the only issue is whether it gets to 4% or 3%. Well, that depends on the data. And the first thing to say today, the OECD realizes that they got their output call wrong. And I was looking at France. They're forecasting positive growth for France, the weakest for the UK. They all look overly optimistic. France has just had its first quarter GDP reduced from 0 to negative 0.2. So are you really going to argue that it's all going to be just fine in quarter 2, quarter 3, and quarter 4? I think the answer is we really don't know, Lisa. We really don't know. And to actually argue we know what's coming is just a wing and a prayer. We don't. There are counter arguments on the side that the labor market is much looser than you think. I have strong views about that. I think it is. I think people have completely got the labor market wrong, as I've said for a decade. I'm happy to talk more about it, and I've been thinking and working a lot more recently.
But Danny, do you think that the reason why the Fed is taking the approach that they have is because it is politically infeasible for them not to come out with a much harder line, despite the fact that, as you say, there could be a more material slowdown, but right now that is not the main economic problem facing the U.S.?
Well, in a sense that, I mean, you may be right, but the reason that you have an independent Fed is to try and cut through that political push. I would have liked to see a more balanced discussion on the one hand, on the other hand. I mean, yes, you argue that politically, but that's the reason you have an independent central bank to say, hang on, folks, we're going to cut through the political rhetoric. We're going to cut through what politicians want us to do. And we're going to try and look at the data and understand what's going on. And I don't really see that. I mean, I think if you go to the UK, the votes on the MPC for rate rises last month and 3 people wanting more, a meeting coming next week. And basically, there is a counter argument to say that you shouldn't raise at all. So I'm not saying that you shouldn't, but I'm just saying that the argument is much more balanced. Output potentially is going to fall. And the big thing we know is that at points where return downs come, the revisions get you. So the consumer confidence data around the world is predictive of recession. It's predictive of a recession in the United States, in the UK, in Japan, and in Europe. Now, you can ignore it, but this is the best data we have. And it just strikes me that all of these folks, maybe politically being pushed there, but they're being pushed into making an error. And what you need to see is a balanced discussion saying, on the one hand, the consumer confidence data are saying this. In Europe, we've certainly seen a collapse in the last 2 months, collapse in people's views about their financial situation, collapse in consumer confidence, which and we know with Christine Lagarde and the ECB is taken very seriously. So if they're taking it very seriously, why is there not a serious discussion at the Fed? The worry is the Fed is beaten by events, and it starts to see some horrible data that it's really not prepared people for. Horrible data on the real economy, on the labor market, on output, on retail sales, on defaults.
Yeah.
So I think it's just we need to balance this discussion. And I certainly think that, if you look at the FOMC and you look at the MPC, the discussion is unbalanced, and that's potentially dangerous.
Danny, one thing we can agree on, groupthink is deadly. Yeah. It's great to catch up, buddy. Good to hear from you. Danny Blanchflower there of Dartmouth. TK, a lot of groupthink through much of last year, and some people might argue that's why we are where we are.
I would watch the outliers from the groupthink, including this morning, dollar yen, wow, 134.20.
Futures down 0.4% from New York. This is Bloomberg. Live from New York City this morning. Good morning to you all. Your equity market looks like this, down 0.4% on the S&P, on the Nasdaq 100, down 0.4%. In the housing market, there's a canary coughing. It's not dying, but it's coughing just a little bit, and you're hearing it cough just a little louder. Mortgage applications, Tom, down 6.5%.
Everyone's watching this. Of course, we turn so much in New York City to Jonathan Miller and Miller Samuel, but John, it's a national study, and that's because of the fears here, the ramifications if and when it snaps.
And how does that fold over to the broader economy, Tom? Can you imagine a scenario where housing prices start coming down, but energy prices are still higher?
No, can't imagine that. But is
as a policymaker, that's
optionality?
Tough.
You got to look at it. Absolutely.
Difficult moment, TK.
No question about it. Futures at negative 18. Of course, Dow futures here negative 152. Right now with us on housing and a beautiful microanalysis he does, Ian Shepherdson, chief economist, Pantheon Macroeconomics. In your United Kingdom or in this United States of America, what's the number one thing we get wrong when we analyze house price ascent and rental ascent?
I think the problem is that people look back instead of forwards, because especially in the US market, we get a lot of information telling us about where housing is going, but markets tend to focus on things like the home sales and home price numbers, which kind of tell you where we've been. And the mortgage numbers that you just mentioned are a great indicator of where we're going, and they are horrific, even though... If we look
define horrific. That's a large phrase for shopping.
Okay, so they peaked in December, and by May they were down about 25% from the peak. They're still falling, so this month, June, by mid-year, we'll probably be down about 30% from the peak. I don't want to annualize that. It's too scary, but it points to a massive fall in home sales, which is already underway, especially in the new home sale market.
I have the clearest memory of 05 or maybe middle 06 looking at the potential mean reversion of housing prices. And we had a very mean reversion of housing prices. I believe that was the year. I could be off by 5 years. Are you looking at this? Is it a mean reversion or more of a housing plunge?
This is more of a volume plunge story. So what we saw in the Great Crash was a huge wave of forced selling from people whose adjustable rate mortgages reset when the Fed went from 1% to 5.25. They couldn't make the payments. We had a wave of forced selling, plus all the new buyers disappeared. So prices completely crashed alongside volumes. This time's different because we haven't had an adjustable rate mortgage boom over the last 10 years. So all that's happening is that the new buyers are disappearing. But they're disappearing at such an incredibly rapid rate that the market is going to move downwards in volumes very, very quickly. We're already seeing it in new homes. We'll see it in existing homes over the next few months. And it's possible that that speed of that drop in sales is enough to trigger maybe a short-lived decline in prices rather than a sustained multi-year crash like we saw back then. But the psychological shock of seeing home prices go from plus 20% just to -5, I think would be quite big. And the other thing we have to remember is that if we're going to see a really big drop in home sales, then everything that's connected to that, a lot of retail sales, building materials, furniture, electronics, appliances, all of this stuff tracks home sales. All of these businesses are really going to suffer when volumes drop by 30%.
Yeah.
This is underway now. The process is just beginning.
Ian, that's where I wanted to go as a tea leaf, as some sort of canary. What does this serve in order to say about the pace of the potential, I don't want to say downturn yet, because perhaps that's too dramatic, but just slowdown in economic growth in the United States?
Yeah, this is an interesting one because, housing, when it crashed in 05, 6, 7, 8, was the whole economy. And it pulled the rest of the economy to pieces with it for years. This time round, I think it's much more kind of siloed. So I think it's entirely possible to have a housing rollover without the rest of the economy following suit. Now, this is not something that we've seen frequently, but it's possible this time because the circumstances are so different to anything we've seen before. So, we've still got consumers sitting on $3.5 trillion of excess cash, which they seem, at the moment anyway, to be quite happy to run down every month in small increments and keep the retail sales numbers going. And remember, consumption is nearly 70% of GDP and housing is 5, 6, 7% of GDP. So it is possible for housing to roll over and the rest of the consumer to keep going. But, we don't know. And we've not seen this before. It's possible that the rollover in the housing market crushes confidence to the extent where people say, hey, I'm going to pull back on my other spending. But this is really uncertain. And what I think hasn't happened yet is this uncertainty has not permeated through to markets or through to the Fed in terms of their interest rate discussions, where housing still doesn't really get a mention. But I'm pretty sure over the next few months, maybe as soon as the June meeting, but maybe we got to wait till July, September, they're going to have to acknowledge that housing is not just softening around the edges, it's actually rolling over. And that rollover is going to really make the policy conundrum even more difficult for them. So this is a real potential threat to this 50-50-50 idea that markets have got very deeply embedded. And I think we're going to have a rethink. Now, I don't know about the timing or the extent of this rethink, but I'm pretty sure it's coming because we can't just ignore a housing meltdown on this scale.
Yeah, and here's the problem for the Federal Reserve. They wanted tighter financial conditions to bring down inflation. A key component of inflation is rent. Rents have increased dramatically. It's not clear that it will immediately send rents lower if you do see a complete loss in the momentum in the housing market. How much is that part of the problem, that rents are going to stay higher and even go higher even if you do start to get a deceleration, even a drop in housing prices?
Yeah, this is an issue for them because even if prices drop tomorrow, I wouldn't expect to see that filtering through into rents until next year. So they're kind of stuck with that for the foreseeable future. The silver lining for the Fed here is that wage growth has actually a bigger driver of rental inflation in the CPI than home prices. And wage growth, I think, I'm pretty convinced now is moderating. It isn't weak, but it's certainly a lot less dramatic than it was maybe last summer, where we saw annualized numbers like 6% plus. We're now down maybe at 4%. So that might give them a bit of relief, but it is going to be awkward for them because that rent component is slow moving and it lags, and it's 40% of the core CPI. So this is they're going to end up having to perform a sort of a juggling act here, whereas at the moment it's very easy. We just bang the table and say we're going to be raising rates to dampen down inflation. That's just like a straight line narrative. It's going to become much more fuzzy and much more difficult and much more multifaceted as the summer goes on.
What's important to me, Ian, is the job formation out of the pandemic was remarkably linear, whether it's curvature, log, whatever, but it was step by step by step, beautifully sequential. I don't buy that on inflation. What point is where the next move down in inflation gets hard? Is it at 5%, 6% gloomy, or can we make it to 4% before we really have a challenge to drive inflation lower?
Well, a great deal depends on energy prices, which I'm just going to put to one side and call it a wild card because I don't know where.
Well, take core. Let's work off core. 6% right now.
So if we look at the core, I think we've already seen a moderation in some of the components which are not really sensitive to COVID and are more sensitive to wages. So, airline fares are still going crazy, but that's a very small component. You look at the bulk of it, that moderation in wage growth, I think, is already beginning to creep through at the edges. So it's hugely dependent on the view that you take of the labour market. Now, right now, the numbers are all over the map. We've got 11 million job openings, which is a ridiculous number, 2 to 1 with the number of unemployed people. Yet wage growth is already moderating. Now, which is going to become the dominant force over the next 6 months? I just don't know. I've got no precedent. I can't point to a previous experience and say, well, the last time this happened, the outcome was X. There is no last time. But if the wage numbers do continue to moderate and we see just a leveling off in energy prices, then I think we can see inflation early next year getting really back down to some quite low levels, which will kind of transform the policy debate. And hopefully, if the economy hasn't rolled over by then, people will be starting to talk about, well, hey, maybe this expansion is going to have some legs. And we don't need to think about a recession in 23 or 24. Maybe we can look at a cycle more like the late 90s, which lasted for several years, despite substantially higher interest rates than we have now. But this really is an exercise in threading the needle, kind of in the dark, wearing gloves. It's not easy.
Ian, being in the dark, what's your highest conviction right now in terms of what we expect to see through the remainder of this year?
Well, first of all, housing is going to be the talking point in the second half of the year because it's to me, this looks like a total disaster area, really coming up very quickly. And the second thing is that I'd be amazed if the Fed is able to go 50-50-50 at the next few meetings in a straight line and without any pushback from markets and without any acknowledgement of what's going on in the housing market. The third thing I'd say is that the rest of the economy, to me, actually looks pretty good. We got threats from every direction. We got China's COVID mess. We've got the people at the bottom end of the income scale being squeezed by gas prices. We've got higher food price inflation, but we've got consumers with $3.5 trillion of cash in the bank, and that, to me, keeps most of the spending going, even if housing rolls over.
Ian, thank you, sir. Great to have you with us in New York City. Ian Shepherdson there of Pantheon Macroeconomics. Greg Jensen of Bridgewater out with an interview in the Financial Times this morning. Here's a quote for you. They may tighten in a very strong way, which would then crack the economy and probably crack the weaker companies in the economy too. Tom, they're betting on a sell-off in corporate bonds in Europe and in the United States.
That's a discontinuous feel of going from point A to, say, point K, and along the way there'll be massive data dependency, which will allow the Fed to adjust. They're not going to do it in a big jump condition. They're going to be massively data dependent and adjust as they go.
It is the last 10 years, Lisa, in reverse for policymakers on so many fronts.
Greg Jensen is not alone. And I was referring to that Deutsche Bank report also talking about more defaults to come and a real default cycle. How do you parse out what corporate credit is worth at a time when suddenly 10-year Treasury yields provide actual yield, right? Where all of a sudden the Fed is not about giving a put or trying to calm markets, but to actually get things a little tighter. This is uncharted territory, and people are trying to understand what the corporate credit market used to look like and transpose that into the size of what we're looking at right now.
Toxic brew.
Toxic brew, Tom.
I'm not saying that you
Brahma,
come
you've
to
been
me
asking about this. I agree.
on higher corporate credits.
Totally.
I'll give the argument.
Totally. And you've been asking for this for a long time, just reintroducing a little bit more price discovery.
I'm not asking for it.
You've been saying that we need a bit of price discovery in the market.
People are worried about zombie companies getting money that don't deserve it. And that's basically the fear. And are we going to see a reversion to some sort of lack of that free money? And what does that look like?
I agree with you. I'm not sure why Tom's being so mean this morning.
Well,
I'm
toxic
know what it's about.
brew dependent.
Just getting ready for Friday, Tom. 1 p.m. Futures down 0.5%. On the S&P, you're furious about that. And the Nasdaq down about 0.5% as well.
My scheduler did not. I got a staff of 14, John.
It's not going to work out.
The scheduler, we're going to get an intern. The scheduler's gone. We're getting an intern in.
You do it on location, Central Park with a cigar.
Great. I was thinking
you'd do it. I'd watch that.
Can I do it at the bar at Benoit?
Of course. Ginny Bill coming up. Michael Kontopoulos, David Stubbs as well in the next hour on Bloomberg TV. From New York City, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Credit Suisse is considering a round of job cuts after warning of a second quarter loss. Bloomberg has learned the cuts would be spread across divisions, including investment banking and wealth management. It was Credit Suisse's sixth profit warning in the last 7 quarters. Former German Chancellor Angela Merkel warns that isolating Russia isn't possible long-term. In her return to the public arena, Merkel said in an interview that Vladimir Putin made a big mistake by invading Ukraine, but she said there's a danger of Putin forming an alliance with China if he does get boxed in. Microsoft is joining the list of prominent tech companies cutting back in Russia following the invasion of Ukraine. The company says it will significantly scale down its operations. Microsoft had already suspended new sales of products and services in Russia. More than 400 employees will be affected. In LA, a billionaire developer will take on a veteran politician in the race for mayor. Rick Caruso will face Congresswoman Karen Bass in November. Caruso won 41% of the votes in yesterday's primary, while Bass won 38%. Both are Democrats, although Caruso is a former Republican who did not switch sides until January. And the son of the founder of Walmart, Rob Walton, is leading a group that has agreed to buy the National Football League's Denver Broncos. ESPN reports that the Walton Group offered almost $4.7 billion. That would be the highest amount ever paid for a U.S. professional sports team. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
What these companies are doing is acknowledging that there is weakness ahead and that you have some companies that are saying, you know what, we're not even going to offer guidance because we just don't know. So I think that what is happening is that you are continuing to see that floor be revised downward, but I don't think that ends up being a very solid floor.
Sam Stovall, just brilliant yesterday with CFRA on free cash flow and the use of cash of corporations off the shock of Target yesterday. Really no equivalent today. Futures at -18 and the VIX, I'm going to call it quiescent, 24.61. On the turmoil of Japan, Kriti Gupta.
Thomas, the dollar yen hits 134, of course, after the comments coming from Governor Kuroda saying that monetary tightening is not suitable here. We have to look at the ripple effects, and that's really brings me to my chart of the day. You have the offshore yuan relative to the Japanese yen, and a massive, massive shout out to Cameron Krice here. And here's why. These are both major Asian exporters, both major net importers of oil, and both are getting hurt by higher commodity prices. Both are also competing to export to the rest of the world. The significance here is when this currency pair, once again, the offshore yuan relative to the Japanese yen, hit that 20 level back in April, and then going further back in 2015, it has created some devaluation in the yuan. In fact, back in April, when it hit that 20 level, the dollar versus yuan started fixing higher, once again speaking to the fact that they are looking to compete more with the rest of the world, specifically with Japan. So when we're talking about simply how much exports are going to cost and how much weaker the Japanese yen or the Japanese yuan could get, keep an eye on this currency pair.
Kriti Gupta, thank you so much. Greatly appreciate it. We pulled him off of a beach. Damian Sassower joins this morning with Bloomberg Intelligence on emerging markets. Damian, is Japan an emerging market? Is their central bank theory so screwed up that they're literally EM-like with their zombie companies and their completely illiquid bond market?
I don't think they're EM-like at all, but what I do think is the impact that Japan is having on emerging markets, most specifically China, and Kriti alluded to it, is significant. I mean, look, Japanese exports are weakening. They're becoming more inexpensive in the broader market, and that is definitely going to weigh on the China yuan, the Korean won, and the rest of the Asian complex, and we're seeing that.
Are we at a tipping point? A lot of people we've talked to have said 135. We're advancing weak yen to a 135 level right now, new high, new weakness for the day, 134.29. Do you have a 135 as a SAS-hour radar? Or is
140, 150, oil at 200. No, I'm kidding. I mean, these are big numbers. I mean, it's very difficult to pinpoint a number.
What is the big number for their institutions where they blink?
I think we've passed it. I mean, I think we're far gone. I think where the yen is, there's really no top to it now. With 20 at yuan yen, with 135 at dollar yen, I mean, no one really knows where the top is in many of these markets. And so the market's going to pull on that thread. You take what the market gives you. And right now, the path of least resistance is to short the yen versus all G7.
Damian, on a credit perspective, there's still concern about what's going on with China and what the slowdowns, the lockdowns, the reopenings mean in terms of the entire region and the exports we saw fall off a cliff to the United States from China. How are you gaming out where China is and what the next shoe is to drop when it comes to the bleed-through effects on the rest of the developing world?
Well, the next shoe to drop, Lisa, is total social financing. We're going to get that print this week. We know what happened last month. The market was calling for 2 trillion yuan of liquidity injected into the system. It came in with less than $1 trillion. And the problem really is that Chinese banks, it's not that they don't have the cash to lend, it's that there's no demand for credit in China because of the lockdowns. Right now, hopefully that's changing, right? We saw the PMIs improve a little bit last month, but we're looking to that TSF figure. I mean, we're looking for new yuan loans. We're looking for loans to medium and small households. We're looking for a big number of over 2 trillion yuan. And even if we do get that, they're going to run into a liquidity crunch come June, July, just based on some of the back of the napkin numbers I'm looking at, Lisa. They're going to have to cut the RRR rate. And, you know, we only saw a 25 bip cut last time. It may need to be more than that.
Have some of the Southeast Asian trading partners with China and, frankly, the rest of the world really factored in perhaps a 3 handle on the GDP print from China, even if it's not said by officials, if it's something like that in real terms?
Well, I mean, forget about the Asian complex. I mean, just look at what's going on out along the frontier. You've got Sri Lanka in default. You've got Nigeria and Kenya who are going to have to devalue their currencies pretty significantly. The Pakistan's looking for an IMF loan. I mean, El Salvador, I mean, my goodness, they have a Bitcoin bond that's coming due next month, $38 million coupon payment, and their Bitcoin that they bought in the market over the last few months is down 40 million. So how are they going to make that payment? I mean, these are the issues that are really front and center for me across emerging markets. The Asian complex is managing really, really well. The inflation impulse in Asia is far less than we'd seen in other regions, specifically Latin America. And so, you know, they're able to weather the storm, at least in the near term. I'm talking the Philippines, who have already started tightening, and others like Malaysia.
Oh, come on, Damian. I'm looking from call it an 80 to a 134 on yen. Is Japan devaluing their currency? Is that the end strategy? Is that the leakage out of the steam kettle of this fictitious fiscal effort?
I mean, that is
it's a devaluation.
It's a devaluation, absolutely.
President Trump, if he was president, would be out on Fox this morning screaming bloody murder about this.
Tom, you sit up here all day long talking about how central banks target unemployment and inflation at the most fundamental level. They're targeting currencies, right? Because without currency convertibility.
What is the ramification to the people of Japan, or frankly to Toyota, of a forced depreciation of the currency over decades?
A lot more tourists. No, I'm kidding. I'm joking. But, you know, truthfully, that's what they're kind of leaning on, is the fact that they're going to see more people coming into Japan, more people spending money in Japan, more people kind of seeking out Japanese goods and services. And so maybe that is kind of the competitive devaluation that we're in the midst of.
Lisa, this is like kryptonite, the way Sasauer's doing this. Do you realize, Lisa, and for those of you on radio, Sasauer's wearing a New York Yankees tie? And he expects
I didn't even know that.
To concentrate?
I don't think anyone's expecting that. I do think that the yen right now is a major issue, and I do wonder what it means in terms of central bank action, at what point policy prescription has to change. Damian Sasauer of Bloomberg Intelligence, thank you so much. And on that point—
Are you serious? The yen matters because the Red Sox need middle relief.
Hey, look, I just have to jump in here.
Please.
I mean, the Yankees have the best record in baseball, the best record since 2001, and we have Nestor Cortes on the mound tonight. It's going to be phenomenal.
Can they stay healthy? Damien, it's unbelievable what they've done.
Yeah, unbelievable.
It's unbelievable.
But you don't watch baseball anymore. You only watch the National League.
I watched National League, but they even ruined that. You know, I watched some Cubs last night. Hi, Lisa.
How's it going?
It's going good. Damien Sassauer, thank you so much.
I was trying to make a point, actually, about when policymakers' hands were going to get basically called. And we're seeing that with China with respect to reversing some of the tightening in financial policies, and they're trying to loosen them up a little bit more. And how much have we really seen the peak tipped in Japan as well?
I would say, Lisa, you just don't know when it's going to push, but it just keeps going. The vector of Turkish lira, 117.19. I made a joke. Lavrov's going to show up at 17 and leave with an 18 handle. And I'm sorry, I go back to the elephant in the room, which is through the show this morning. Lisa, yen has moved out 134.37. What are they going to do? Turn purple at 135?
When do they start to care? When do they start to realize that this is increasing their imported inflation in a dramatic way?
They won't show that they care. They'll just fix it. And how they fix that is fascinating. We'll unfortunately have to have Damien Sassauer on with his Mets tie tomorrow. We will continue, folks. Futures at -21. Need to stay with us this morning. This is Bloomberg.